Inflation. It's not so much just a Trump trade or not.
Some big moves in this bond market. Will break them down. Up next on the program from New York, this is Bloomberg.
Why does this business model work? Because it's virgin space. It's never been done before, and it'll never be done again. When you step back and you look at something that's been golf through institutions, has been the way it has been for 53 years without change. In 1993, I stepped back and said, okay, this is not right. It's doing the same old Groundhog Day. Everything's the same. Players are a pass-through entity. They're not getting any equity built in their day. Once they're done playing, they're out. I thought, that's just not right. When you have to build a sustainable model, you need to have these players, these famous, the world best, the best of the best. You need to give them equity into the future. You need to give them a vision of where they need to go and how they're going to get there.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
The morning of that interest rate cut from the Federal Reserve back in September, when they dropped 50 basis points, the 10-year yield opened up at 3.64. Look at things now, 4.20, a move of 50 basis points plus on a 10-year yield, 4.20.76 and up another single basis point this morning. Under surveillance this morning, deciphering the Trump trade.
If one candidate is talking about tariffs and another candidate is talking about higher taxes, they're both a tax. What does that mean to me as an investor? Inflation. And that's one of the reasons why I think you see yields starting to move higher. It's not so much just a Trump trade or not. All of this is putting upward pressure on rates. And I think this is something that we're going to have to deal with as we move into the next months ahead.
So here's the latest. Bond yields surging to their highest levels since July as traders pair bets on Fed rate cuts and begin to price in expectations for the U.S. election. Kurt Ryman of UBS assigning a 45% chance Harris wins with a split Congress, writing a Democratic sweep would likely be the most negative outcome for equities. Markets would likely cheer a Republican sweep for its lower taxes and lighter regulation. But this could be partially offset by concerns about the costs and inflation impacts. I'm pleased to say that in the studio, Kurt joins us now. Kurt, good morning to you.
It's good to be with you.
You are in a fantastic seat because you sit on both the fixed income side of things and you have to deal with the politics in this election over the next few weeks. Can you tell us how much of an election impact you think we're already seeing in fixed income?
I think there may be some of an impact because it's not just happening in the bond market. You're seeing it in some of the sectors within the stock market that would tend to favor a Trump victory. And his numbers have improved in the polls recently. But I think the bond market's also telling another story, which is that the front end of the yield curve was pricing in more aggressive Fed rate cuts than we thought was reasonable. But also the growth backdrop has improved. So we've seen a bit of a bear flattening of the curve over the past, call it, month or so. I think that move higher in yields is more about a growth pickup than it is about anything related to necessarily concerns about inflation. So if we get inflation leading to higher rates, then I'm concerned. But at a call it 4.15, 4.20 yield on the 10-year, that's looking more attractive. Yeah.
So you don't think actually what the bond market is saying is Trump winning?
I think this is much more about the growth backdrop. I think the election outcome is very much a secondary factor because let's face it, the polls are still very tight. This can go either way. The battleground states, 4 of them are within a percentage point. So this is not an election that has been decided. We still have, as you know, a couple of weeks to go. Because of that, it would seem unlikely that the bond market and the equity market would be pricing in today a more complete picture of how this election is going to unfold.
But as Jim Caron was saying, whether or not it's Harris or Trump, it could be inflationary. With Trump, you get tariffs, and with Harris, you get higher corporate taxes. Both of these could be very inflationary. Also, there's going to be tax cut for people like in the middle income. Why wouldn't the bond market just be pricing in that environment?
I think that's missing a big element of what we're seeing unfold in D.C. over the next administration, or at least the next 2 years, and that is constraints on government. So you think about the Senate and the House. If you get a united government, you are going to have very narrow majorities. And the prospects for divided government under Harris are quite high because the Senate looks very likely to shift Republican. So when it comes to all of the policy prescriptions that have been put out on the campaign trail, not a lot of them are going to get done. I think when it comes to personal income tax cuts and extending those, we'll probably get most, if not all of them. But on the corporate tax side, when you think about the current state of deficits and the debt load, adding another tax cut in the case of Trump is going to be hard to do with the fiscal hawks. And if you have divided government under Harris, well, I mean, then that's just a non-starter.
So if you don't think that what we're seeing right now in the bond market is a Trump trade, are you saying that the market is not going to price in some of those fears of higher deficits, higher inflation, et cetera, in the direct aftermath if Trump does win? In other words, could you see yields climbing quite significantly in the immediate aftermath?
Yes, there's going to be the knee-jerk reaction, as there always is. We could get a bear steepener of the yield curve in the event of a Trump victory. We could get the dollar appreciating quite a bit, even though it's already very expensive. So you think about some of those reactions, yes, but then I think the market's going to get back to what is the foundational elements of the markets that we're seeing today, which is that the economy is strong, that the Fed is cutting interest rates into the end of next year and maybe even further than that. We've had strong earnings growth. We think earnings growth is going to remain strong next year. Where are the concerns on a Trump victory? Yeah, sure, it's on tariffs, but then the question is how strong will they be? They get more stagflationary the more that tariffs are raised, but then that has sort of cycles back on itself. If it becomes inflationary and bad for the economy, then maybe that'll be a signal to the administration that they want to do a deal or make some kind of an adjustment.
Terry Wiseman was talking about how his key tell will be if the dollar weakens in tandem with yields going higher after this election. Do you see that as a possibility if international investors get concerned about the U.S. deficit?
Yeah, I mean, I still think that deficits and debt are more of a secondary factor. They're not showing up in influencing where the bond market is headed. The bond market's principal direction is coming from the macroeconomy. It's coming from the decline in inflation rates, the sort of trend rate of growth in the economy, or if you will, nominal GDP. I mean, we're sort of getting back there. I also think, though, that it's possible that the dollar could weaken, very likely, because it is so strong right now. So the longer-term view, and what we tell our clients is, keep with the long term. Keep the focus on your strategic portfolio weights. Focus on, and make some tactical trades if you can that you think make sense. But for the most part, hew towards your strategic asset allocation.
Kurt, this was great. We've got to do it again soon. It's good to see you.
Look forward to it.
And before the election, 2 weeks to go. Kurt, thank you. Kurt Ryman there of UBS. Coming up next to the second hour of Bloomberg Surveillance, Cameron Dawson of New Edge Wealth, Mary Allen Klass of Bloomberg Opinion, Torsten Slock of Apollo, and Chris Marinak of Janney Montgomery Scott from New York City. This is Bloomberg.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
To succeed in Wall Street, what skills do you need? You need to be somebody that claws people on the back, people that you have to be tough, you have to be fighting people all the time. What are the skills that really take to succeed in Wall Street?
Great question. Of course, you have to work hard. So I can tell you what I found for me, and it's probably counterintuitive. I had to stick out, which is interesting because I made the decision earlier. Being really the only woman, I already stuck out, and I thought I might as well double down on that. I can't hide. So how did I do that? It was by being a contrarian. And I refused as a research analyst to ever publish research reports that said me too. That said, oh, IBM reported earnings. They came in 2 cents ahead. One of the pennies was currency. The other penny was lower G&A, blah, blah. Forget it. Big calls on big stocks. My very first piece of research I published was very negative at a time nobody did it. I stood the heck out. And when I was right, that elevated me. And David, I've done that as a research analyst, but I did it in business as well. Here's a business strategy. If everything's fine, just keep your head down and execute. Every once in a while, you have a big insight, and you can build an entire business, in fact, an entire industry around it.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
If the micro is murky, we're going to focus on the macro.
The base case for us is still an economy that just softens up a little bit, doesn't go into recession, not even close, as inflation continues to move back down to its target.
What's really, truly in the driving seat is the fact that the economy is resilient, and that has been on full display.
That is not the type of economy that typically would get significant easing ahead, but the Fed is committed and the direction is clear.
It also now calls into question the need for additional rate cuts, at least in the near term, as we look out to that November policy decision.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg surveillance starts right now with a lively debate about this right here. Bond yields in America climbing by double-digit basis points in yesterday's session. The 10-year moves from 410 to 420, 420.56, and up another single basis point this morning. Likewise, at the front end of the curve, up another single basis point, north of 4%, 4.04%. The debate around the table, is it the data or the politics?
We've seen a lot of better than expected data, including earnings that have beat expectations, and companies have been rewarded for that. If you look at the underpinnings of this yield move, a significant portion of it has come from real yields, so adjusted for inflation. They have risen from about 1.5% to almost 1.9% on the 10-year. If you take a look at how much is from inflation expectations, a little bit, but basically this is basically a commentary on people demanding a higher premium to own longer-term U.S. bonds in the face of a whole host of uncertainties.
And maybe right now, when you look at it, we don't know the outcome of the U.S. election. It could be about growth. What's the Fed's path forward? But if you do look at the politics of it, other parts of the market are pricing in a Trump trade. And for some people, they're looking at the betting markets, looking at the financial markets, and they're saying that could be the outcome. We're getting ahead of it. What does a Trump trade mean? Basically, higher inflation certainly next year. Adam Posen has talked about this, and potentially the Fed then hiking. Or you just look at this and you say, regardless of who wins, there's going to be a lot more fiscal spending.
So let's get beyond bonds, because it's not just bonds, it's financials too. So we had a rally on the banks. You can sit here and say, well, it's going to be a lighter touch on regulation if it's Donald Trump. Sure, possibly. But the difficulty you've got with the financials is the same difficulty you have with the bond market. It's very difficult to unpack what is about the fundamentals and what is about just the guessing game of the politics and the election that's 2 weeks away. Likewise on the financials, the earnings were decent. For the bond market, the data was good. Which one is it, the politics or the data or the earnings? I don't know. Maybe it's a mix of all of the above.
How about just yes? I mean, basically, this is the reason why people feel like they're staring into sun. Just to keep repeating Lori Calvasina over at RBC Capital Markets, there is a sense that it's very hard to distinguish valuations from the reality on the ground. It is something very hard for people to bet against, considering that it is a two-pronged type of wager.
Goldman Sachs came out with a note last night, and they spoke to two individuals that I think are really important for the Democrats and the Republicans. Kevin Hassett, the former chairman of the Council of Economic Advisors under Trump, and then Jared Bernstein, the current individual. Kevin Hassett, extending the Tax Cuts and Jobs Act and relaxing scrutiny regulation should be the priorities and could be enacted quite quickly. Then he goes into a host of reasons why there should be tariffs. Jared Bernstein, I would prioritize the two big pieces of unfinished business, affordable housing and childcare, which I consider to be pretty existential market failures. What does this mean? This is a ton of fiscal spending coming out of Washington, honestly, regardless of who wins.
Equity futures right now on the S&P 500 pulling back in the face of this move in the bond market. Stocks are down across the board. On the S&P 500, we are negative by about 0.5%, down much more. On the Russell, the small caps down by 0.7%. Bit of outperformance, GM. A beat and a raise. General Motors in the pre-market, Lisa, up by 1.4%.
Not only did they beat the third quarter earnings per share, but as you mentioned, they really put out there the full year projection that was at the higher end of estimates between $10 and $10.50 a share. A real question here about how different the U.S. auto manufacturers are from European ones. Is it because they are more isolated from China, or is this not a rejection, but their own take on the EV transition, the pace that they want to go at, and how much they consider that to be a potentially profitable area versus big trucks?
More on that story a little bit later. Very big trucks, very profitable big trucks.
That's right.
Coming up this hour, Cameron Dawson of New Edge Wealth with Treasury yields at the highest level since July. Mary Ellen Klass of Bloomberg Opinion on why one-party control is steamrolling voters. And Torsten Slok of Apollo explaining why he's still in the no-landing camp. We begin this hour with Treasury yields inching higher as investors reassess the outlook for monetary policy and fiscal fears grow just 2 weeks out from the election. Cameron Dawson of New Edge Wealth saying 10-year yields are moving higher because economic surprises and Trump Republican sweep odds are rising. We would not be surprised to see a near-term jump in yields that could be reversed post the election. Cameron joins us now for more. Cameron, welcome to the program. Let's do the lessons of the previous cycles. What is the lesson from 2016 with regards to some of the moves we're seeing right now?
It's a really important one, which is that after the surprise election of Trump in 2016, what you saw was an over 100 basis points jump in the 10-year yield in under 2 months. But then as we got into 2017, you actually saw yields start to fade and trade lower, even as we were negotiating things like the Tax Cuts and Jobs Act, which did contribute to the overall deficit. So we could be in a sell the rumor, buy the news kind of scenario with bonds today, where you're pricing in the potential of these higher deficits. But the reality is that a lot of the policies that could contribute to higher deficits, like the extension of those tax cuts, don't get negotiated until we get closer to the end of 25 and into 26. So we could have this jump higher in the near term and then a fade post the election potentially.
Cameron, this is fascinating, regardless of who wins. Is that correct?
I think that is correct, because what we see is that both candidates are talking about potential additions to deficits, and they're really not considering things like all-out austerity. Now, there are offsets to the things of the extension of tax cuts, for example. So if we think about from Trump's camp, he's talking about offsetting the tax cuts through tariffs, whereas through Harris, she's talking about offsetting the extension of personal tax cuts through higher corporate taxes. But even with all of that, you see this contributing to overall deficits, which just means that we have to get used to higher Treasury issuance. We have to get used to these higher deficits because neither party is talking about all-out austerity.
The interesting thing about this, Cameron, is a lot of people expect that this type of scenario with more fiscal spending, with bigger deficits, yes, come with higher yields, but also with more robust gains for a lot of equities, because a lot of companies will maybe do better if there's less regulation, fewer taxes, et cetera. I see you shrugging, and that's exactly what I wanted to ask you. How much is this the opposite? How much does this really lead to the draw of higher yields, sucking investors into the bond space at the expense of equities and the returns there?
I think a lot of that hinges on what the Fed does in this environment. If you go back to Econ 101 classes, you would typically argue that if you have highly stimulative fiscal policy, you should not have highly stimulative monetary policy because you get inflation. And what's interesting is that given the fact that you have high fiscal stimulus at the same time as an underlying economy that remains resilient, you're now having the Fed talk about potentially hundreds of basis points of cuts to get back to this phantom neutral rate, which would effectively be like throwing lighter fluid on a fire already of this underlying strength within the economy. So it raises the question of, if we actually get these kind of deficit blowouts, do you get as many cuts as the Fed or the bond market has currently priced in?
Is that potentially more of what the market is reading into, less of the politics?
Quite potentially so. I think that Lisa's point earlier about inflation break-evens is interesting, because one of the things that you've seen is this all-out confidence by the bond market that the Fed will be in fact successful of getting inflation back to 2%. And though we don't see signs today that inflation is reaccelerating, look at things like wages, look at oil prices, observable rents, none of those point to an imminent reacceleration in inflation, but we don't think we can rule out higher inflation, or at least stickier inflation in 2025, given the backdrop of stimulative monetary, stimulative fiscal into a stronger, resilient economy.
Cameron, you brought up a really good point when it comes to TCJA, the extension of these tax cuts, and that needs to be hammered out throughout the course of the entire year and probably won't get done until the very, very end of 2025. But what about tariffs and tariffs' implications for inflation and the bond market?
Yeah, that is something that could be done immediately, and it could certainly weigh on growth. We usually think of tariffs as a regressive tax, that it weighs on consumption. It's a big question of if tariffs across the board, not the kinds of very focused tariffs that we saw during Trump's last term, but if we got these broad tariffs across the board, could it contribute to inflation? Because you're talking about putting tariffs on things that we simply can't produce in the US, whether it's things like bananas or fish, where we tend to import most of what we consume. So that would be inflationary in the sense of it's a one-time reset in prices. And the question, does that catalyze a greater reflationary cycle? Something similar to what we had, of course, coming out of the pandemic, where it effectively acts as a supply shock. And that's where we have the biggest question, is that if you get tariffs and immigration restrictions, could you see a supply shock that is somewhat similar to the pandemic and thus get your second wave of inflation?
So Cameron, we've got to put some money to work with all of that in mind. Equity still close to all-time highs, credit spreads near multi-decade tights, bond yields at the highest since July. What do you do right now?
I think a certain degree of patience is warranted, mostly within credit markets, which are very much priced for perfection, and broad equity markets, which we think are priced for perfection as well. There are still opportunities under the surface where we see names that are trading at more reasonable valuations. We think that valuation discipline probably is the most important thing to have at this time, given the starting point of such extended and elevated valuations. So it's really coming back to the fundamentals of finding companies that we like with strong balance sheets, strong free cash flow, but aren't being given those big premium multiples because they don't have as exciting of narratives. So we think that you have to remain ultimately valuation disciplined. Don't get over your skis, because this market is not contemplating any kind of growth slowdown or any kind of inflation reacceleration, which we think could be two different kind of polar risks as we go into 2025.
Is this a polite way of saying that you think that probably Goldman Sachs is right, that the annualized returns on the S&P 500 index level probably are going to be pretty tepid over the next decade?
It's certainly possible. We do know that lost decades do happen within equity markets, but the biggest and most important message there is that that doesn't mean to be uninvested. What we typically see in periods of low returns is actually big rotations in leadership that provide opportunities for investors. So you go back to the 70s, it was a lost decade, but the leadership shifted away from big growth Nifty 50 stocks to value stocks. A very similar thing happened in the 2000s. So there's opportunities of the volatility that can happen in a low return environment as well. There's a lot of ways to get to 3%. You could chop sideways for 10 years. You could have a big rally and then a crash, or you could have a crash and then a recovery. So it's incredibly path dependent. So there's a certain marrying of the tactical, which provides opportunities, with the strategic. Even if you knew with certainty it was going to be 3%, you have to know what that tactical path is going to be.
Cameron, appreciate your take. As always, thank you. Cameron Dawson there of New Edge Wealth on this equity market. Your stock market right now negative. Close to session lows. We're down by 0.5%. With an update on stories elsewhere, here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Some earnings to get through this morning. GM higher pre-market 1.6%. The automaker reported third quarter earnings that beat Wall Street estimates. It raised its full year guidance. There was strong U.S. demand for SUVs and trucks. All of that offset losses from its EV business and continued red ink in China. Elsewhere, GE shares also now lower pre-market 5.6%. The company did report a jump in third quarter profit. It also raised its full year guidance. The aircraft supplier is capitalizing on a strong order book and maintenance service businesses. It also had an improved outlook. It does point to GE's adaptability to a volatile environment plagued by supply chain issues. A day after the New York Liberty won their first WNBA title, a new contest is emerging in the league. According to the union, players opted out of their collective bargaining agreement 2 years before it expired, pushing for a more lucrative deal. If the two sides indeed do reach a deal, it will go into effect in 2026. If they can't reach one, though, a lockout might occur that season. The union said that it has a handful of priorities for negotiations. That includes getting a cut of revenue, higher salaries, improved benefits for retirees, and pregnancy. And that's your brief, John.
Danny, thank you. More from Danny in about 30 minutes' time. Up next on the program, the partisan divide.
We've been through a lot together, haven't we? Huh? We suffered for 4 years.
We need to be able to have these good, intense debates about issues that are grounded in fact.
That conversation up next, live from New York. Good morning.
We spent some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have Take-Two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching The Close.
Welcome to Balance of Power.
This is Bloomberg.
Two weeks out from Election Day, and this market gets more and more interesting. Pulling back from all-time highs, we're down another 0.5% on the S&P, and the interest at the moment firmly on the bond market. Yields up another single basis point, Lisa, 420.56.
A lot of people discussing, and we've been discussing it all morning, how much has to do with the expectation for the results of the election, how much has to do with better than expected data. You see both when you underlie the actual yield rise. You see it both in inflation expectations. You also see it in the extra premium, the real yield over inflation expectations.
2-year up another single basis point, right now 4.04%. Under surveillance this morning, the partisan divide.
We've been through a lot together, haven't we? Huh? We suffered for 4 years. For 4 years, we suffered. Our country suffered.
We need a healthy two-party system. We need to be able to have these good, intense debates about issues that are grounded in fact.
So here's the latest this morning. Kamala Harris highlighting the importance of a healthy two-party system. But Bloomberg Opinion's Mariana Klass pointing out 82% of Americans live in a one-party controlled state. Mary warning at steamrolling U.S. voters, writing the shifting dynamic is suppressing competition in elections, discouraging voter engagement, and in too many places, enabling the party in power to ignore perspectives outside of their base. In short, political choice is vanishing. Mary joins us now for more. Mary, welcome to the program. Let's start with how you define one-party control state, and ultimately, if it needs fixing, how do we fix it?
Well, one-party control is when both houses of a state's legislature and the governor are under the control of one party. And we are in this situation, as you mentioned, 82% of the country is in a state controlled by a single party. And this is the highest we've seen in 70 years. In modern history, we really haven't seen this kind of lopsided control at the state level. And it really does kind of result in fewer people having their voice heard. And, you know, it goes down to the point where there's a lot of legislation that's passed that, according to the data, and we really looked deeply into what was happening, there are so many decisions that are made that only one party is voting on. There were 2,000 pieces of legislation on big items passed between 2021 and 2024 without a single vote from the opposing party in states across the nation. So this is really a lopsided situation.
Mary, to understand where we are, can you walk us through how we got there?
Sure. Well, a lot of it has to do with the fact that we've really watched gerrymandering happening, where one party that assumes control wants to retain it and, you know, jiggers the map in such a way that it benefits its own party and reelects people. We've also watched as there's just been kind of a growing apathy among voters. When two parties don't compete, it obviously suppresses voter engagement, because there's this, you know, fewer people are elected, or fewer people are competing for the same jobs. And the thing that is really kind of stunning is the number of people that at the state legislature level that walk into office with either only a primary, or even more alarming is with no primary and just walk in without competition. This year, 38% of all state party legislative seats will be filled without a challenge from the opposing party. So really, that's thousands of seats, like 2,100, 2,100 and more. And that signals that we really have an absence of competition, which means that these super majorities have control of a legislature and can push things through.
Mary, I'm thinking of the South, though, and some big red states like Florida and Texas. 9 of the 15 fastest growing cities are in the South, according to data. And when you look at what's happening there, is you're actually even seeing some competition in, say, a statewide Senate race when it comes to Texas. Aren't the demographics shifting that potentially could mean more representation for, say, Democrats in the South, or maybe even Republicans in the North, because you do see people migrating in different directions?
Well, it's one thing to have a electorate that is got blue and red, and it's another thing to have the state legislature. And that's what we are seeing in places like Georgia that has two Democratic state U.S. senators and a Republican governor. The Republican legislature there has been under one-party control for decades. And that is reflected in the kind of policies that they are passing at the state level. Texas is another example. Yes, there may be competition in these Washington, in congressional related seats, and actually in some places within the Democrat, within the governorship. But when it comes to the state legislature, where all these policies that can affect people's lives, that's where the competition has disappeared. And that has an effect on people in many ways. I mean, states will be certifying the presidential election this year. States determine how much Medicaid gets to people, healthcare decisions, broad decisions as it relates to education, obviously. And we will be talking a lot more about that if Trump is elected, because he wants to continue to push decisions back to the states like abortion, as we've watched. So yes, there is some competition in some of these big states, especially those that are growing in their blue metropolitan areas, but we don't see that reflected often, especially in the South, in their state legislatures.
Mary, just to sort of pose a hypothetical to you to give a better sense maybe of the picture, are you saying that gerrymandering has made it so that even if there is a significant majority in the population of the opposing party, you still would see a single party rule that has been the same for a very long time in a lot of states?
That's exactly right, yes. And once the party is in control, they can draw the maps to make sure that their party stays in control. And, the answer to this is to reward competition. When you elect someone, when you have a choice between who's going to be elected, look at the people that are more willing to work with the other side. When they ice out debate, when, legislative leaders shut off the mics and don't want to, let others even discuss an issue. And even more importantly, when they don't hear the bills of the opposing party. That is the kind of thing that continues to reinforce this sort of vicious cycle.
How much are we seeing, Mary, people vote with their feet? I mean, if they don't like a state's policies, can't they move to another state?
And we are seeing that there seems to be some sorting in that regard as well. But think about that. Do we really want to be a state where, if you happen to be in the minority party, you have zero voice? Geography should not determine destiny when it comes to a democracy. Your voice you should have a right to be heard. And it doesn't mean that your party's always going to, has to control everything, but there needs to be sort of that bipartisan willingness. And what our data shows is that it's increasingly less likely, especially in red states, that the policies that are passed have public support. So, we looked at there's a lot of data out there from some really smart political scientists who've looked at the kind of policies that are passed in red trifecta states or blue trifecta states. And we analyzed that and found that 53% of the major policies passed in red states received the support of the majority of voters, and blue trifecta states had the support of 77% of voters.
Mary, we've got to leave it there. It's good to get your thoughts on this subject. Mary Ellen Klass of Bloomberg Opinion. Certainly very little evidence is hurting turnout over the last few cycles, that's for sure. Torsten Slock of Apollo on why he still sees a no landing in America up next.
Welcome to the world of decentralized finance.
We thought we'd take a look at Bitcoin versus the S&P 500.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
It's really a tale of two cities in crypto.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Or other authorities.
Could face bigger challenges next.
It was going to keep reading World Cup. This is a 3
as the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
In about 60 minutes' time, we'll sit down with Gilles Moak of AXA. And Gilles going to compare the United States to Europe, and we'll talk about the different perspectives on the US election, 2 weeks away. Take a listen to Seth Carpenter of Morgan Stanley. In the US, a majority of clients doubt former President Trump's resolve to add the substantial tariffs he's promised. But over in Europe, clients in London were convinced that he should be taken fully at his word. two very different perspectives based on where you live right now on tariffs in America.
How much of this is because of what people expect the ramifications to be? A lot of people saying the ramifications will be a lot bigger for European companies and countries in terms of higher costs and lower earnings if the U.S. does put up the walls, even to some European allies.
Yeah, I'd agree. I'd suggest the same thing, that that's dictated, determined by varying degrees of fear about what it might mean for them personally. Yeah. We'll catch up with Gilles Marbeck and get his opinion in about 60 minutes' time. Equity futures on the S&P 500 look a little something like this, pulling back on the S&P, pulling back on the NASDAQ, lower on a Russell 2000. We're down by 0.6% on a Russell. On the S&P 500, down by 0.4. The fireworks, as we've said a few times already this morning, is in the bond market. 2-year, 10-year, 30-year, shaping up as follows. Yields just a little bit higher, much higher in yesterday's session by double-digit basis points from 410 to 420, 419.77 on a 2-year, 4.04%.
It's sort of shocking to see how the yields have basically bounced back to where they were before we got that July weak jobs report. Essentially, we have retraced any of the expected sort of deceleration of the economy, the need for the Fed to cut rates aggressively. We've gone full circle, and yet the Fed is still planning to cut rates, and they have already cut rates by 50 basis points. What's interesting here is this is a market grappling not only with election risk, not only with the Citi U.S. Surprise Index for economic data coming in at the highest level since April, but also the prospect that going forward, we are going to end up with a significantly higher neutral rate than maybe they thought a couple months ago.
Go back to when the Fed cut interest rates 50 basis points. Where was the 2-year? Where was the 10-year? The 2-year was at about 360. The 10-year was at about 360 something. Look at where we are now. That's a big repricing of the yield curve after some Fed easing and the promise, by the way, of more to come. This market's not been driven by Fed speak. It's been driven by the data, and the expected data 1 year out based on what may or may not happen in an election 2 weeks away.
Especially when you add to this the earnings that show the companies are in really good positions, and the consumers can keep spending. It is what is it, sort of soft landing nirvana that we've been talking about now. Maybe we have to ask to take a page out of this one man's book. Is it a no landing nirvana? And maybe we can catch up with that man sometime soon.
That man is around the table and a few minutes away. I want to finish on foreign exchange. The dollar off the back of those high yields, just a little bit stronger. Euro dollar coming really close in the last 24 hours to breaking down to 107. 108.27 is where we trade right now. Under surveillance this morning, shares of GM rising in the pre-market. The automaker delivering a beat and raising its full-year guidance. The company adding, quote, "We remain on track to reach our 2024 EV production and profitability targets." That stock lease are up by 1.1%.
What struck us both, all of us, was this real divergence between U.S. auto manufacturers and what we've heard from the European ones. Yes, it is a stark difference. What I want to hear from the earnings call, looking forward, what kind of growth is there? How much is this a U.S. auto manufacturing sector that's ready to rip versus just cutting costs, being disciplined, and executing where they can? And that's going to make the difference between a potential stock that could really gain and an entire industrial sector, or maybe just, okay, you guys did a good job. What do you have for next quarter?
Especially as the battery-powered models continue to lose money for GM. You have Mary Barra saying the company is working to, quote, make our EVs profitable as quickly as possible. How much harder is that going to be if you start to dial back some of the subsidies that consumers can get when it comes to purchasing electric vehicles if the politics change next year?
We've said this a million times. The destination for government officials is still the same. They want a full transition, but they've had a massive reality check about how long it's going to take to get there. And the automakers, particularly in Europe, are pushing back and saying, your goals now are so unrealistic that we can't make them, and you've got to admit yourselves that we're not going to make them. And plus, by the way, you still need to provide more state aid to incentivize the purchase of these vehicles. And if you don't, we're going to have to shut a lot of factories across the continent.
Which is the reason why at the IMF meetings, at the World Bank meetings, they're going to come out and say, deficit, deficit, deficit. Look at how terrible it is. Look how much public debt there is. At the same time, the auto manufacturers are saying, you need to spend more to support us, or else we're going to have to close plants, and that's going to mean losses of jobs. So it's sort of a double-edged sword here between a rock and a hard place for the European auto manufacturers.
GM right now in the pre-market up by about 1%. Some good news from Maersk, raising its full-year guidance again for the 4th time in less than 6 months, perhaps for the wrong reasons. The shipping giant citing stronger demand and higher freight rates caused by attacks in the Red Sea. Maersk signaling it expects the Red Sea to remain unsafe well into next year.
We are a year into this conflict, and still you do not see the regular flow of trade going through the Red Sea. Now they're going around Africa, and that is why it is so expensive. And Maersk, they don't have a timeline. Why? The U.S. government doesn't have a timeline on when potentially they're not going to have vessels being hit by Houthis within the Red Sea. I think that is a very underappreciated story for this global economy and the impact of what that story alone means for inflation.
This is not really something you can provide a timeline for, is it?
No, absolutely
Ultimately,
not.
this comes down to policy. Are you going to provide an appropriate, adequate deterrence in the region or not?
Well, the deterrence is there right now, but what does it mean? It means that basically U.S. men and women, service members, are protecting what kind of vessels that are willing to go through the Red Sea? Oh, Russian and Chinese. Not Western vessels. Why? They're too concerned that they're going to get hit by Houthis. They're the ones that are paying up these costs and going around Africa.
That's the latest on Maersk and that situation in the Middle East and particularly through the Red Sea. And I wish we'd spent more time on that in the campaign, but such is life. We didn't. The U.S. continuing to ramp up pressure on Russia's war machine. A senior State Department official telling Bloomberg Washington will tighten the screws on Russia's liquefied natural gas. The U.S. sanctioned a new Arctic LNG export facility just last year, but stopped short of sanctioning other plants. Elsewhere, Treasury yields continue their climb on election expectations and easing rate cut bets. Torsten Slock of Apollo saying 10 tailwinds are increasing the likelihood that the Fed will have to reverse course at its November meeting. In short, the no landing continues. Torsten's with us around the table. Torsten, good morning.
Morning.
When you say reverse course, do you mean pause or start going the other way?
I mean pause.
You mean pause?
Yeah.
Okay, share the 10 tailwinds with us.
Well, so the key tailwinds, of course...
Not a memory test, pick 5.
Okay.
I was about to
There's a lot
say.
of things that are supportive, of course. First of all, most importantly, when the Fed turns dovish, financial conditions begin to ease. This has been a very strong tailwind just in the last few weeks since the September meeting. Second of all, underlying the growth outlook, we also have the CHIPS Act, the Inflation Reduction Act, the Infrastructure Act. Those are also very strong tailwinds that continue to provide support to construction of manufacturing facilities. We also have on top of that a lot of spending on data centers, on AI. I have not met anyone who is saying, oh, I'm not going to build a data center because the Fed just raised 25 basis points. On the contrary, this is a structural force. It doesn't matter what interest rates are doing. At the same time, we also have, at the highest level, stock markets are rallying, credit markets are very tight, and at the same time, consumers are still very strong. So overall, the tailwinds in the form of what will the outlook look like for the next several quarters just continues to not be surprising why we're getting still 254,000 jobs, why GDP growth in the second quarter was 3%, and Atlanta Fed GDP now for the third quarter is 3.4. I mean, you really do begin to ask the question, where is the slowdown? And as we have been debating before, is monetary policy really restrictive? If it is so restrictive, why is the economy still doing so well?
They don't just believe it's restrictive, they believe it's sufficiently restrictive to get inflation back down to 2% over a certain period of time. Do you have your doubts then?
So, well, it becomes a bit of a semantics of what exactly does it mean, because it was for a long time the argument that when the Fed funds rate is where it is at the moment at 5%, and if we are supposed to go to our star, which is 3%, that must imply, if you have that model in your mind, that we have very restrictive policy. But the incoming data across the board, if you look at the daily data on your Bloomberg screen for how many people go to restaurants is still very strong, how many people fly in airplanes, daily data also very strong, debit card spending on my Bloomberg terminal, also daily data very strong, weekly data for retail sales strong, the number of people who are at the moment spending across basically most categories of consumption, as we saw in the retail sales report last week, also very strong. So in that sense, it's not even the case that there was a slowdown last week. It's still the case that things are still chugging along very nicely.
That said, you are seeing in surveys and talking to different executives that they're not really planning on hiring mass groups of people, that they're actually allowing attrition to shrink their workforces. You are seeing signs that there is a sort of evening out in the labor front, and that seems to be the big concern for the Federal Reserve that sees that as a slower moving ship. Why do you think that isn't enough to really create a landing?
Well, if you look at the Challenger Gray and Christmas survey of the announced job cuts, that's still very low. This is a monthly series where they go out and ask companies, are you planning to do mass layoffs? And the answer to that at the moment is there's no increase in mass layoffs. In the JOLT survey, the layoff rate, meaning the percentage of people who lose their jobs, is at 1%. So total employment in the U.S. is about 160 million people have a job. So the layoff rate means that 1% get involuntarily fired every month. So that's 1.6 million people. But that's been very flat for the last 2 years. there's no increase in the layoff rate. So in that sense, yes, there's a lot of worries, and there's certainly a lot of things on the horizon, including election, geopolitical risk, other things you can begin to think about. But the bottom line still is that the incoming data, it just continues to show that the economy is doing just fine. Jobless claims, we had some hurricane issues, but look at the next non-farm payrolls report. If we do get that at 150 or 200,000, we could easily get a scenario where the Fed will basically have to reverse course and begin to stay on hold.
Are you saying that you're completely discounting the next jobs report that we get?
So I will say that I think the pain trade for the market is that if it's a lot better, because everyone is expecting it to be bad now. So that's why if everyone expects it to be bad, then well, that could either be the economy slowing down or it could be the hurricanes. But imagine if that comes in at 150 or 200, then I think the market will say, whoa, maybe things are not that bad. So I think taking the totality of the data, the mosaic of what's going on in the incoming data, it still tells me that we are in the no-landing scenario. It's just really difficult to argue that monetary policy is restrictive.
How many more months of this do you need for the Federal Reserve to come round to your view of the world? Is November 7th too early?
So I do think that the next employment report obviously is very important, but I think that everyone is expecting it now to be bad. So that's why I think it will not take much more than a little bit better than expected employment report.
What is bad, by the way? Because you said 150 might be sort of the pain trade.
Well, as you know from Tara Watson and Andy Wedelberg at the Hamilton Institute at Brookings, they have been quantifying what is the level of employment growth now we've had so much immigration. And their estimates have said, well, we should be more like 200,000. Now the question is, well, if we do get 150, well, that will certainly be below that. But if you're correct for hurricanes and all the other things that are holding things down, well, then I would say a good report would certainly be even something at 150. Bad would be below 100,000. But at the moment, again, the totality of the data that comes in, it completely justifies both why Fed's pricing is changing and also why long rates are going up.
John asked a question about potential reinflation, which I think is a really important one, because even as people see all of this robustness, they still see prices on a year-over-year basis continuing to come down, and that alone is enough to justify some of the Fed moves. When you take a look at the panoply of potential policy that we could potentially get, when you start talking about manufacturing more in the U.S., when you start talking about tax cuts, how much does that actually feed into inflation? What are your models looking at?
Well, what's most important is what is the fiscal impetus? In other words, how much does it support GDP? And of course, if you look at it from the broader perspective, the Trump tax cuts that are running out by late 2025 become very important in that discussion. But that's still quite some time away, only in 2026. So the story here and now is still in the very near term that we still have tailwinds from the fundamental reasons why the economy continues to do so well. But to your question, Lisa, what really becomes important for inflation is that if this easing that now is being signaled by the Fed begins to mean that we still have more job growth, we still have more wage growth, which are very important drivers of housing demand. That means that the 40% of the CPI basket that is housing, if that begins to reaccelerate, then we could have the risk that inflation begins to move higher again. So that's why we're watching very, very carefully what's going on in the housing market at the moment, because there's already a number of indicators suggesting some more signs of life, which could potentially begin to be that problem that inflation could begin to move higher because of housing inflation moving higher.
Is that just a vicious cycle? Basically, people think the Fed's going to cut more, so they start to potentially look at maybe getting on the property ladder, maybe going out and getting construction done on their homes?
Well, the Fed has since December been signaling that now rates are going down. The pivot in December of last year was certainly after having said for several years rates are going up, to now say rates are going down. And at the same time, the key drivers of housing demand, of course, are three things. Mortgage rates, of course, they are a little bit up now again, but the two other key factors are wage and income growth, and at the same time, job growth. And wage growth and job growth still doing fine. So it's not surprising that we're seeing the housing indicators begin to show more signs of life.
Let's talk about fiscal policy. You see in the bond market today, some people coming on this program saying this is down to a Trump trade. Do you believe that?
Well, if you look at your Bloomberg screen at the term premium, both from the San Francisco Fed by Jens Christensen and also the New York Fed term premium, they have been going up quite a lot. And when did it start to go up? It started going up exactly after the last employment report. So in that sense, I would say that most of the rise in the term premium we're seeing here, meaning most of the rise of why is it that people are now betting higher rates to go up and why is the yield curve steepening, is because of this issue that people are looking at it from that the business cycle is simply a lot stronger than what we thought before. So there's probably a lot of people that are squeezed out of the short view, meaning that the economy is going down and maybe it's now not going down and therefore rates have to go up. But there's probably also a lot of people that are beginning to come to the conclusion that, hey, maybe monetary policy is not as restrictive as the Fed has been saying and as the market has been telling itself for quite some time.
Torsten, in your scenario, your look at the world as it is, does that mean that where rates are, even if they go to 4.5% on the 10-year, you could see a sustainable rally in equities, that essentially this is a less bond-sensitive equity market than a lot of people think?
Well, I do still think that corporate earnings are actually still doing quite well. What really is the key issue for investors is that if yield level is higher, that means that private credit will continue to give you higher yields, fixed income will continue to give you higher yields, and for investors and asset allocation, the key message is we are not going back to zero. So therefore, capital structures that were put in place when interest rates were zero will continue to be vulnerable, or put in different words, companies that have earnings continue to be attractive, both on the debt and on the equity side. And the reason why that's important is that that also means for equities that this discussion about small cap relative to large cap will continue to dominate the debate in the equity space, because small cap will continue to be vulnerable if rates are higher for longer. Because again, if I have a company with no revenue, no cash flow, no earnings, of course, when my debt servicing costs go up and stay higher for longer, of course, I'm going to get in trouble before other companies that actually have earnings. So that's why it is all about investing in companies that have earnings and looking at it both on the debt and equity side. And that's why those parts of the equity and private equity world where you invest in companies with earnings will generally tend to do a lot better.
Torsten, this was a clinic. It always is. We appreciate it. We've had a healthy debate over the last few months on this topic, and the data's moving your way. That's for sure. Torsten Slok there of Apollo with an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Strategists at Citi are out with a new warning that exposure to the S&P 500 has reached levels that were followed by a 10% slump in the past. The team isn't suggesting that investors move to reduce their exposure, but they do say positioning risks are rising. The S&P 500 is up over 20% so far this year. Norway's $1.8 trillion sovereign wealth fund returned 4.4% or $76 billion in the third quarter. Those numbers reflect broad equity gains on declining interest rates. Norway's central bank, which is the world's biggest single owner of listed equities, added 4.5% on stocks in the period and 4.2% on fixed income investments. All of that according to a statement this morning. Russia and President Vladimir Putin are playing host to the country's biggest gathering of world leaders since the invasion of Ukraine. Leaders of 32 countries and a host of organizations will join the BRICS summit starting today. Members are split on the direction of the group and interests as a counterweight to Western countries. Nations are debating less reliance on the U.S. dollar and challenges to cross-border payments to circumvent the global financial system. And that's your brief, John.
Danny, thank you. More from Danny in about 30 minutes' time. Up next, room to run for the banks.
The amount of liquidity in the markets is phenomenal. The banks have plenty of room to lend. They see the economy looking better.
That conversation up next, live from New York. Good morning.
Do you think it'll be the case where someday you will be an investment committee or I'll be an investment committee and we just apply AI, decide whether it's a good deal or not, or we're not going to be there anytime soon?
I don't think we'll be there in the near term. And David, because, being on investment committees, there's the analytics of the math, there's the people, and then there's judgment. So analytics of the math, I think AI will help us get way more refined. Right now, we have analysts building models upon models. Our typical investment memo is 86 pages. So we could refine that down very, very seamlessly to pieces. The people aspect to it, to make a judgment call on, do I believe this entrepreneur is going to go the next mile? Do I believe that the background of the entrepreneur, who they are, what they stand for, their values, their family, that's the harder one. I think AI is going to take some time to get there. And then the final piece ends up being judgment. And I don't believe we've seen anything yet that gives us a sense of judgment that we're able to apply.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
The equity market rally stalling just a little bit this week. Down yesterday, just a little bit. Down this morning, just a little bit. We're down by 0.5% on the S&P 500. Under surveillance this morning, room to run for the banks.
The Fed is truly going to continue to ease and cut rates between now and the end of next year. We're in the soft landing. The amount of liquidity in the markets is phenomenal. The banks have plenty of room to lend. They see the economy looking better. We could see better lending, particularly in commercial and industrial lending, as companies start to build out inventories, take on capital expenditures, and the commercial banks will be beneficiaries of this.
So here's the latest. The big banks rallying on the back of earnings this month. Chris Marinak of Janney Montgomery Scott writing, we see many other banks capable of catching up to the leaders as their third quarter earnings have been solid, and more importantly, their outlook for fourth quarter and early 2025 is positive. Chris joins us now for more. Chris, it's been quite a run for the major banks. The big banks on the S&P 500 up by more than 25% so far in 2024. In your opinion, the recent move, and there's been some debate on the program about this in the last few days, is it about the earnings or the politics, or a little bit of both?
I think it's more about earnings, John. I think earnings are signaling that credit is much better than anticipated. If you go all the way back to spring of this year, there was a lot of credit fear in the banking system about another failure round like we had in 23. That is completely in the rearview mirror now, and the industry is in a much better place. We've had credit losses, credit problems being very much under control. The signals for fourth quarter and early 25 are that credit's going to stay very low on losses. And the Fed's recent cut gives a lot of flexibility for any problems that exist in commercial real estate, in C&I, and elsewhere. So I think we're in a really good spot. And now you have the acceleration of net interest income and net interest margins because of the Fed cut. It'll be interesting to see if the Fed does pause to today's conversation. But I think overall we're in a very good spot.
Chris, do you think that smaller banks, regional banks, are ready to start accelerating their lending arms? Basically, we're wondering about the state of the economy. Have we gotten to a point where yields are low enough for them to really be major lenders once again to a lot of the small businesses in their communities?
I think we definitely are. I think banks were on a diet for the last 18 months on their balance sheet to try to keep liquidity high and give themselves some capital flexibility. Now that is completely behind us, and going forward, I think demand's going to pick up. For a bank to go from 2% to 3% growth is actually very important, particularly when net interest margins are starting to inch up, and they are. So I think the inflection point on revenue is very much here. So I do think lending is going to improve, and I think the pace next year, particularly with the no landing scenario, could be quite positive.
Do you have a sense of the risk appetite of some of these banks? And I like that you talked about the no landing. We were just talking about Torsten Slok, and this fits perfectly into that. I mean, if you have banks that are reaccelerating their lending mechanisms into an economy that looks pretty good, well, don't you really start to look at a reacceleration and perhaps even inflation levels, benchmark rates staying at this level for a longer period of time?
Sure, I think it's a real scenario. It's one of the reasons I've been very loath to kind of cut my forecast for the Fed. I think the Fed funds is going to be slow to 450 and 425 as next year plays out. So that's exactly right. And I think in general, a little bit of steepness in the yield curve is very healthy. And if anything, the cost of funds has rolled over and peaked. So that's allowing bank margins to get better. Right now, you want more volume. So I think the risk appetite is incrementally better. It's not going to be dramatically higher, Lisa, but I think it will be better than it had been the past 3 to 6 months.
Chris, let's make sure we finish on top picks. What are they?
I like Fifth Third, FITB, Synovus, SNV, Wintrust, WTFC, and we also like WAL, Western Alliance, which we think was penalized on Friday.
Appreciate it. Interesting. Chris, thank you, sir. Chris Marinac there of Jenny Montgomery Scott on the banks. So let's compare and contrast some notes, shall we? Came into this morning asking, is it the data or the politics moving the bond market? Torsten Slock of Apollo suggesting it's the data. Had a conversation there about the banks. Stocks are doing quite nicely. Is it the earnings or the politics? It's the earnings, according to Chris Marinac.
He's talking about the likes of Western Alliance, which was one of the most beaten up stocks during the whole regional banking crisis. This looks like a fundamental story that has the overlay of a whole host of people who are looking to make some kind of definitive statement about the election that we have to deal with for another couple of weeks or maybe more, and have to make something sound smart with. I'm sorry, not to be skeptical, but I think that there's a lot of that.
No snark there
I mean,
whatsoever.
if you think about it, all of these analysts have to talk to clients about the election, and they have to come up with something smart to say. Okay, this could be it, but I mean, honestly, do we know anything about how it's going to really shake out?
Number one question I have is, how quickly do you think we'll get a result? How long do you think it will take? How many days?
Oh, God, do you really want...
End of the week?
I hope, you know, it'll come right away.
If we're lucky?
We'll know right away. It'll come out. No, that's going to take a long
2021
time.
days. This could maybe be weeks.
Maybe longer. Like, who knows? Coming up for the next hour, Brent Schutte of Northwestern Mutual, RBC CEO, Dave Mackay, Jill Moak of AXA, and Jitanya Kandari of Morgan Stanley Investment Management. Live from New York, this is Bloomberg.
In 2015, I was not optimistic because nobody was working on the hard problems. The energy R&D budgets had gone down. The venture investing in climate had gone down. It was completely out of fashion. So I don't know what people were optimistic about then. The fact is, we built essentially from scratch, you know, with lots of supporters, a really mind-blowing level of innovation against emissions. And, you know, in the last 9 years, that's gone better than I would have expected. So only now could you even, you know, plausibly be optimistic about the path of emissions. And someone who said, hey, nobody's ever scaled things up very like the speed that we knew to before, they're welcome to say, hey, I'll believe this when I see it. You know, in the meantime, some people who care about this issue are really out, you know, trying to think, do we need permitting reform? You know, do we find, what new ideas haven't we found yet? You know, how do we fund people with those new ideas? How do we get the costs of these things down? How do we collaborate on a global basis? So we're still not at the point where it's guaranteed or even that it'll be easy, but at least there's a theory of change.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
What about artificial intelligence? Is artificial intelligence going to enable you and others to say, we have enough information to know exactly what something is going to be worth in terms of insuring it or not?
Artificial intelligence is finding its way into our business in a variety of different factors. I think the first piece is getting much better insight into data, which allows us to make better decisions on underwriting. It's also a great opportunity to service business better in terms of like call centers and different ways of what's using robotics and other AI will be very helpful. But it is an emerging practice within the industry and one that is evolving very quickly. So it's also going to present risks that, other companies, how they use it and how they use large language models, and making sure the decision making is very sound. So it's complicated, but it definitely is benefiting the business today.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
If you look at the environment, at least in the U.S., it is pretty encouraging. Stocks reflect that. If you're printing earnings growth like we're printing, then I think it's going to be hard to keep people out of U.S. equity markets.
Sentiment is probably not overly enthusiastic, but certainly bordering there.
At these valuations and at these levels, it makes it hard to have a positive surprise, and it makes it easier to have a negative surprise.
At the same time, look at equities. That's where I look.
I was a little shocked by how directly you called out Apple and their closed approach. Can you kind of expand on that and where Apple has been a blocker for Meta and potentially others?
Yeah. I mean, my point in there is more, it's a little more philosophical on how it's affected my own kind of approach towards things, and psychologically sort of affected how I think about building stuff. I actually don't know how they're going to approach AI. They do some open development, they do some closed development. By the way, I think it's worth noting, like, I don't actually consider myself to be an open source zealot. I just think that in this case, I think that open models are going to be the standard, and I think that that's going to be good for the world. But we do open development, we do closed development, so I get it, right? And I'm not saying that Apple's necessarily going to be on the wrong place on this for AI. But if you look back over the last 10 or 15 years, it has been a formative experience for us, is building our services on top of platforms that are controlled by our competitors. And for a number of different incentives, they absolutely, from my perspective, apply different rules to kind of limit what we can do. And yeah, they have all these taxes, and at some point we did we've done some analysis that we think we'd be way more profitable if it weren't for some of these arbitrary rules, and I think a lot of other businesses would be too. But honestly, the money part, I think it's annoying, but for me, it's not the biggest thing. It's I think it's a little bit soul crushing when you go build features that are what you believe is good for your community, and then you're told that you can't ship them because some company wants to put you in a box so that they can better compete with you. And my concern for AI at this point isn't actually Apple, it's more the other companies and how that would evolve. And I think to some degree, it's not even that, I'm not even saying that they're like bad people. I think that there's just a physics and incentive structure to the system where, if you build a closed system, then eventually there are all these forces on you that sort of kind of push you to kind of clamp down on things. And I think that it will be a healthier ecosystem if it's developed more like the web, but more capable. And I think that, because of how mobile developed, where the closed model won, right? I mean, it's like Apple, I think, has really reaped most of the benefits in terms of, there might be more Android phones out there, but like Apple gets like almost all the profits from mobile phones. I think there's a bit of recency bias because these are long cycles, right? I mean, the iPhone, I think it came out in 2007, right? So
acetate weak areas of the economy, the bifurcated nature of the economy brings with it risk. But simply, there is less room for error when only a fraction of the economy is healthy. Brent joins us now for more. Brent, welcome back to the program. Last time we had this conversation, we were debating whether this Fed is too late. There are people around this table now saying that maybe this Fed was too early. What do you say back to them?
I think that highlights the difficult path going forward for the Fed. Look, investors are way too optimistic that the Fed is going to cut rates in a nice, neat, and tidy way. There is the possibility they cut rates too quickly, the possibility they cut rates too late. They don't know, we don't know, and I think that's where the risks are, is that there is the chance that the Fed has cut too early already and that inflation pressures are coming back. The narrative was the Fed would cut rates, everything would be well, and it would alleviate the interest pain on certain parts of the economy. Well, the Fed cut rates and the 10-year Treasury is 60 basis points higher, which has pushed mortgage rates higher, which has made housing more unaffordable for most every American in the country.
So, Brent, bad if you want to buy a house. Where does it leave the equity market? You were cautious last time around. You were cautious on large caps, I believe. Slightly more bullish on smalls. Has that changed?
No, that's the irony. I mean, you've had a bifurcated economy in a bifurcated market. At some point, we have to get back to equilibrium. How do we do that longer term, I think, is the question, and do we need a recession to do it, which historically has been the way that you've got an economy back into equilibrium. I think the irony is there's opportunities in small and mid caps because, yes, they are interest rate sensitive. Who doesn't know that? I could say stay in quality for a while and it could continue to work, but think about the other side. What happened in July when we thought the other side was coming? There was a ferocious rally in small and mid, which are historically cheap. And that's where I think any investor should think about right now, given that uncertainty, look to valuations, which tend to matter more over the intermediate time period as your guiding light and guiding post. And that's where we're positioned right now.
Brett, I'm trying to put these two things together, and I'm a little bit confused because if there is this risk of a no landing and inflation being stickier than expected, and frankly, longer term yields rising if the Fed cuts more, why go into the more interest rate sensitive stocks that actually hinge and do better when you get more Fed rate cuts, which don't seem like they'd be in the offing given some of the better than expected data and the performance that we've seen in bonds so far?
Look, at the end of the day, the Fed knows how to get inflation down. It knows how to kind of stem inflation overall. We saw what had to happen back in the 80s. To me, it's always about what happens next in market and what's not priced. If you look at 1999-2000, which I think is a perfect example for where we're at when the market was concentrated and we were in economic cycle over time, you actually saw small and mid do better into that recession and thereafter because they had already priced in the fact that it was likely we were going to have a recession. And that's where I think we're at right now. And that's where I think thinking beyond the next 3, 6, and 9 months and thinking out to the next 2, 3, 5 years, that's where I want to be positioned because no one's thinking that way any longer.
One thing that you point out is, and you keep saying, is valuations. That's one of the main drivers for you right now, given how high valuations are, particularly in large caps. That's the area you like least. Why is the argument not valid with, say, investment grade bonds where spreads are pretty tight and valuations are pretty full also?
It is. I mean, look, I agree longer term interest rates are likely to be higher, but I think the path is lower at some point, just because I do think you're going to have a recession to kind of clear the deck of all the abnormalities that are out in the economy, where you have the haves that are winning quite a bit and the have-nots that are not. This is where I think we want to be more towards Treasury debt, even though I do see longer term risk there. I think there will be a flight to quality, much like there was back in July, believe it or not. And that's where I think we want to be positioned more so not so much out on high yield. I think investment grade high quality is still a place to be as you think about the reality that the Fed will only be able to cut rates aggressively if they do see a recession on the horizon.
Brent, we're 14 days out from the U.S. election, so I have to ask about how you're potentially, your advice for positioning ahead of that. You like the small caps. Do you think that is a Trump trade that's on right now because of policy or because of economics?
You know, I think it's a bit of each. Look, I don't want to overweight the election too much. I don't think anyone knows what the outcome's likely to be. And therefore, if I don't know what the outcome's going to be, I don't try to position too much for it. It certainly is in the background. I think the more important thing is the economic cycle, which I keep coming back to. Look, we are later in an economic cycle. Yes, the unemployment rate has risen, but it's still low. Where are we going to find the people to fill the supply that is needed if demand reaccelerates? And to me, that's where I think that's the most important thing. And no matter who wins, I think they are likely to preside over a recession in the next 4 years. And I think they're likely to preside over a market, especially large cap stocks that are historically expensive, that does less. That's where I think investors should be optimistic on the other side, where things are cheaper and will do better, I think, when we get to the other side of whatever lies ahead.
Get to the other side. Yeah, we're all looking forward to getting to the other side. When it comes to, though, this idea of potentially your recession call, could potentially the policy of whatever administration we get next further push the U.S. in that direction? Or do you think that is going to happen regardless?
I think it's likely to happen regardless. Look, you have a really unbalanced economy that has been demarcated by interest rates and ownership of financial assets. It's not balanced. The economy is being pushed higher by higher income and middle income consumers who have had a wealth effect at their tails. If you have debt and you don't own a house, you probably don't feel as confident about what's going to happen going forward. And so to me, I do think there are still risks that are out there, and that's all we're asking is that investors pay attention to those risks and importantly stay diversified, which does tend to pay off at the end of economic cycles, which I think is still out there on the horizon.
Brent, what it sounds like to me is that in some ways you agree with this call that we heard from Goldman Sachs and that Cameron Dawson over at New Edge seemed to agree with, that equity returns on the large caps are probably pretty muted over the next decade or so. And so you're basically trying to shift things around on a valuation basis with that expectation that there isn't going to be some sort of massive acceleration. Is that correct?
100%. I mean, to me, valuation does tend to matter. It does not matter in the short term. It's an imperfect timing tool. But I think about the regime change that's likely to occur. Look, every economic cycle back to the 80s has had new market leadership. And the prior leaders have become the next cycle's laggards because the economy changes and those asset classes are typically priced for perfection at the end. And that's where I think we're at. And how do you transition from what worked in the past cycle to what we think will work in the future? That's the difficulty of trying to explain the positioning that we have. It's just that at the end of the day, valuation does tend to matter. I don't think valuation is dead. I hear that argument. I've been doing this for 30 years. It typically gets loudest at the end of an economic cycle where people are really tempted to concentrate in yesteryear's winners. Eventually that becomes a losing strategy, and that's why I want investors to stay diversified, stay true to their plan, and think about the reality that asset classes don't die, they just go to sleep for a while. And that's where I think there'll be new winners on the opposite side of whatever comes in the next few months.
This was thoughtful. Brent, we appreciate it. Thank you, sir. Brent Schutte there for Northwestern Mutual. If you are just joining us, welcome to the program. Equities just off session lows. We're down 1/3% on the S&P. With an update on stories elsewhere, here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Secretary of State Antony Blinken is making his 11th trip to the Middle East since last year's October 7th attack. He's scheduled to meet later today with Israeli Prime Minister Benjamin Netanyahu in Jerusalem and Defense Minister Yoav Gallant in Tel Aviv. Blinken has been trying to engineer a ceasefire between Israel and Iran-backed militants for more than a year. The U.S. maintains that Israel's killing of Hamas leader Yahya Sinwar last week may open the door for a breakthrough, even though Hamas leaders and Netanyahu have vowed to fight on. Early voting is underway in states across the country. The votes are pouring in. More than 15 million votes have already been cast nationally. Democrats have been leading in the early totals, but Republicans are not far behind. 46% of ballots have been cast from registered Democrats, 36% from Republicans. Walmart will start delivering prescriptions to U.S. homes in as little as 30 minutes. The retail giant announced the new service that will be available in 49 states by the end of January. Customers will be able to receive their medications in the same orders as groceries and other products. It's a direct challenge to Amazon for a bigger slice of online spending. And that's your brief, John.
Danny, thank you. Up next on the program, the Morning Calls Plus, Dave Mackay of RBC on US-Canada trade relations ahead of the election and what's in store beyond 2024. From New York City, this is Bloomberg.
On the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
The Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Equities down about 1/3% on the S&P 500. The opening bell around about 1 hour and 15 minutes away. Big focus on the bond market. Yields coming in now by a single basis point after moving out by double-digit basis points in yesterday's session, up by 10 to about 420. We're back down to 418. Let's get you some morning calls. First up, Bernstein naming Walmart a top retail pick with an outperform rating, anticipating e-commerce profitability growth. The story for that stock up by 0.06%. Your second call from TD Cowen, lowering its price target on Walgreens, boosts Alliance to $14, expecting EPS to continue to fall next year. That stock is lower by 0.6%. And finally, Wedbush, reiterating its outperform rating on GM after earnings, citing its robust delivery numbers. Let's turn to the election. Donald Trump doubling down on his trade policy, telling the Wall Street Journal he's committed to upholding the USMCA. The agreement, of course, up for renewal in 2026. RBC CEO Dave McKay weighing in on US-Canada relations, saying it would be inflationary for America to make everything, so Buy America can't be a go-it-alone strategy. Dave joins us now for more. Dave, good morning. It's good to see you.
Morning, Jonathan.
Let's start there. That's a big talking point for both economies, actually. Where do you think the US and Canada can work closely together beyond 24?
Well, you start with the history. I mean, the longest undefended border. You look at the trade, balanced trade, over $400 billion crossing the border each way every year. 34 states in the U.S., Canada's the #1 trading partner. You take out energy, the U.S. exports more goods and services to Canada than Canada exports the other way. Energy exports from Canada kind of balance that trade. So you look at this long-standing relationship. You look at supply chains that are integrated. Very, very important. But the message is, Canada has a challenge and America has an opportunity. And I think that's the key message. For Canada, we have to put a business lens on our economy. We have to think about how do we become more relevant to the largest economy in the world, fastest growing economy in the world. And you can put a business lens on that. You look at what you're good at and what America needs. And Canada needs to do a better job of aligning to what America needs. America needs Canada to produce more energy, not only for America, but for its key trade partners as well globally. America needs Canada to be more involved in overall security. Canada can play a much bigger role in the Arctic, growing area, trade area, resources, minerals, all of that. So when you think about the relevance of our economies, the integration of our supply chains, the natural resources we have, the people resources we have, America can't go it alone because it's challenged in meeting the demand of its economy from a human resource perspective, from a minerals perspective, and therefore Canada can help tame inflation in America.
I'll try and be diplomatic about this. How big is the spread between everything you said, which just made sense, and the policies coming out of current administrations, both north of the border and south of the border?
Look, America will choose who they want to run the country. At the end of the day, there's some common policy issues I think any government in the United States, and equally any government in Canada as we go through a similar election next year. First and foremost, fiscal deficit. We will not enjoy long-term prosperity unless we get control of our fiscal deficit. And therefore, as we look at the policies, whatever party they're coming from, we have to manage this fiscal deficit. We've already talked this morning on your show about markets trying to digest the amount of debt coming through. How are we going to price that debt? How are we going to float that debt? We have to get control of these deficits. We don't need that stimulus in the economy right now. The economy is strong. And therefore, lower rates will stimulate further business investment. So I think from that perspective, we're looking for policy that really aims at stabilizing and reducing that deficit, I think is really important. So regardless of who's in power, we need that policy change.
But how desperate is the business community, especially in a place like Canada, for policy that they know is going to stick? You're talking about energy, and my mind immediately goes to Keystone, right? 3 administrations, start and go, of this one project with executive orders. Why would any business in Canada want to make decisions about doing business in America?
I think you look at the history, that was one project exactly, and I think everyone's disappointed that we weren't able to conclude that project, even though it was so close to coming online. At the end of the day, we still have the capacity to export to the United States. We're exporting in Canada to new markets. Trans Mountain Pipeline was completed, and therefore we're exporting to Asia increasingly. That helps America as well. At the end of the day, if we can secure energy security for all trading partners, I think that's a big part. So Canada can play a role, even though pipelines aren't being built directly to the United States. We can help trading partners, whether it's in Japan, whether it's in South Korea and others who have an energy need for their growing economies. So there's roles we can play. We're going to go through bumps through the road. This is a long-standing relationship, Henry, as you know, and therefore we will overcome any obstacles. We have to work together, and I think integrating supply chains, leveraging those resources, you have to think about who you're aligned to from an ideology perspective. I think, the democratic process and our belief in democracy, and therefore that long-standing partnership, I think, can flourish to the benefit of both sides.
How are you looking at trade under Harris and Trump? Because regardless of who wins, there's going to be this review of USMCA.
Yeah, I think at the end of the day, when the facts are put on the table in 34 states, many of them red states, many of them blue states, they look at Canada, their #1 trade partner. You look at the long-standing relationship. We're going to have disagreements, I think, at the fringe, the way we did last time. I think milk in Wisconsin was an area of disagreement. There's going to be areas of disagreement. At the core, I think we see the benefit to both nations, and therefore, I think we have to keep that front and center. In business, myself as a leader in Canada and a very large U.S. operation, we as business leaders have to keep the strengths and the need for this at the core. And I think we'll argue at the fringe, hopefully, and resolve those, but at the core, we know how important this is.
How much are you yourself planning to continue the expansion in the U.S., or is that pretty much done?
No, thank you for asking that. We have a fantastic U.S. operation, a top 10 capital markets player, #6 in wealth distribution. We have a commercial bank and a private bank with City National, and therefore, we very much believe we're serving America, and particularly through our capital markets operation, large corporate and institutional. We're serving high net worth and ultra high net worth individuals for the wealth. We're growing each franchise, whether it's the number of investment bankers we hire, the number of traders we hire, the amount of balance sheet we put into the United States continues to grow. We put a significant amount of our balance sheet into the U.S. We're growing our commercial operations into big corporate. And then to your question, Lisa, north-south connectivity. We bank companies on both sides of the border. We understand the needs of the supply chains that are integrated, and therefore we're continuing to build out greater transaction banking and treasury management north-south to help growth in both economies. So we're investing in America, and we call it our second home market.
So to me, this is fascinating because you really understand the cross-border connection for a lot of companies. And I do wonder how much hesitation there is for companies to lean into some of their expansion cross borders, given the uncertainty in policy that we see. Do you see that in practice, or is it the opposite?
No, we do see it in practice. Uncertainty in any outcome for businesses. We see it right now, obviously, in capital markets. There's a lot of dialogue, but we haven't seen the pipelines come to fruition. We see it in cross-border clients where you're thinking about making a 10 or 20 investment. You need to know the rules around those returns, and therefore you're hesitating a little bit. You want to see the policy in action. And therefore, I think as businesses, we have to keep advocating for balanced policies that meet the needs of everyone. I mean, we're really looking at, in many ways, a K-shaped economy. You see it in some of your discussion already today. Businesses and large corporates are feeling a little bit better about things. They're starting to get ready to move forward, but to your point, they're looking and they're hesitating a little bit at the margin. Small businesses are really struggling with inflation and supply chain, and therefore you're seeing a different perspective on investing between large corporates and small corporates. You're seeing the same thing on consumers. The top 20% of U.S. consumers are driving the economy. 40% of U.S. dollar consumer spending comes from the top 20% of consumers. Bottom 60% of consumers, income-wise, are struggling to make ends meet and aren't driving the economy.
Can you give us a sense of how much you expect transactions and other types of investments to come back online after the election, regardless of who wins? Can you give a sense of what kind of volume could get generated after there is some degree of certainty, whenever that may be?
Right. So you're seeing the fee revenue in the pools was up 20%. You're seeing capital markets, M&A advisory pipelines build. We're seeing that in our own pipeline. We're feeling good about that. You're seeing more debt capital markets activity as lower rates trigger that. So it's a combination of lower rates, pent-up demand from sponsors and trying to move some of the properties they've been sitting on since the pandemic. So you see this pent-up need. You're seeing the rate environment being more constructive. You see the uncertainty of the election slowing things down, but you see the pipeline moving slowly through the process, and therefore it portends to an active year in 2025.
Got to squeeze this in with 60 seconds left. How's the housing market in Canada since we last spoke? What's it looking like?
The housing market's stable. Housing's driven by demand. Certainly construction is way off given interest rates, so people, listing ratios are going up. You're seeing slow resale activity. You're seeing slow construction activity, but that demand, given the amount of immigration we have, pent-up demand, so you're still, Jonathan, in a situation of excess demand over supply. We are short 3 million houses in Canada. We're building roughly 250 to 300,000 houses a year. We have a 10-year backlog on supply, and we're more concerned about how fast we're going to build. Therefore, that lends to stability in prices over time, even when demand drops.
It's the time of the year where Americans start to threaten to move to Canada. You know where this goes. David's good to see you.
The weather's coming.
One half of the country, anyway. Dave Mackay of RBC, thank you, sir. Appreciate it. Coming up next on the program, Gilles Moak of AXA and Jitanya Kandari of Morgan Stanley Investment Management. With your equity market on the S&P 500 negative here by 1/3%. Bond yields pretty stable, lower by a single basis point on a 10-year after a sell-off yesterday, the smallest of rallies this morning, 418.57 on 10s. From New York, this is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything. Fixed Income Fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have Take-Two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Equities trading just a little bit softer over the last few days. Monday, touch lower. Tuesday, down by 0.4% on the S&P 500. On the Nasdaq, we're down about 0.5% on the Russell. The small caps also down by 0.5%. With 1 hour to go until the opening bell, let's get you some morning movers and cross over to Manus Cranning. Morning, Manus.
Jonathan, very good morning to you. Mary Barra delivers a couple of key messages at GM today, which is, look, we're doing everything to stop the bleed in China. Yes, it's been 3 straight quarters of where we've lost money, but she reaffirms the guidance. It's about doing what we do best, which is building big old trucks and selling them, whether it's the GMC model, the Chevy Silverado. This is what they do. High margin products, reaffirming the margin, reaffirming the cash flow. EBIT for this year, $14 billion. And Dan Ives says, look, recovery has begun at the Detroit stalwart. I talked about cash flow up by 19% in the quarter. Again, it engenders the story of buyback. So this is Mary Barra really gripping the big issues at GM and delivering. Roll it forward and you have General Electric Aerospace. This stock was up 91% before today. So just put this a little bit in context for you. Yeah, they've lifted the guidance for the whole year. This is about their commercial engine business. This is about the overall structure that they have. But it is the infancy of independence for them. And the CEO, Larry Gulp, says, we are in the midst of a heck of a year. Just think of the supply chain issues around a lot of the aerospace industry. And again, you begin to understand a little bit lighter on the sales number is what's knocking the stock this morning. I leave you with a thought from Kimberly-Clark. This is about Kleenex. This is about toilet rolls. You see, it gets very exciting when I come to do this hit for you. But this is about the sales outlook and the inventory buildup in the retail side. Procter & Gamble told you that the same issues just a few weeks ago. So I'll leave you with that salutary thought. I just want a GMC pickup truck to drive through those cobblestones in Soho. Jonathan, good morning.
Manus Cranny, appreciate it. Thank you, sir. Thanks for the update. Manus Cranny there. Seen that a few times. Manus mentioned it. Kimberly-Clark, P&G as well. Those consumer-facing companies not doing too well over the last few quarters.
I got to go back and check the stockpiling of toilet paper and figure out where that is in terms of the pros and cons. But it does raise some questions. How solid is the consumer, or is it still one sector of the consumer that is paring back and maybe only getting a certain brand that's cheaper than other? Although I honestly, that is one area that I've always actually...
Where's this going?
I always have shelled up for good toilet paper.
Okay, thanks for sharing that. I'm not sure why you felt the need to share that with us this morning. The conversation wasn't going there, but thank you. Appreciate it. Let's turn to the bond market. 10-year yields look like this at the moment. You pull yourself together. We're down about a basis point, 4.19 on 10s. On a 2-year at the moment, just about stable, around 4%. Let's talk about the difference between Lisa and the rest of the world. No, let's talk about the difference between the US bond market and Europe. Gilles Moek of AXA having this to say. The market is now almost exactly aligned with the FOMC's dot plot. Conversely, the same uncertainty doesn't exist in the Eurozone. It seems that investors have made up their mind. Let's get to Gilles for more. Gilles, investors making up their mind that the ECB is going to cut interest rates, and the ECB keeps saying the same thing. We are data dependent. We are meeting by meeting. Is the market in charge?
At the moment, it feels a bit like this, yes, because what is really interesting is that no matter what the ECB has been saying in the last month, basically, what the market has been expecting for what the ECB would do within the next 12 months has not moved really, and it moved by a few basis points, which tells you that markets came back from their holiday recess and started thinking, well, you know, the European economy is not doing well at all at the moment, and inflation is, you know, coming down much faster than what the ECB was expecting. So they're going to cut, and they're going to cut in a fairly steady but quick pace, I would say. So no matter what the ECB says about, you know, we're going to take our time, we're going to look at the data, it's going to be one meeting at a time. Yes, I think that the market has made up its mind, and basically the sort of dovish shift that we had in terms of tone from Lagarde has basically confirmed this hint by the market.
We've talked about the European economy many a time together over the years. The word that I've used repeatedly over the years so far has been dreadful. There are varying degrees of dreadful whenever we talk about the European economy. Could you frame for our audience outside of Europe, here in the United States, how bad are things in the European economy? The PMI suggested in the last month things were pretty terrible. Are they that bad?
I would not use dreadful. I would use mediocre, which I think would describe it a bit better in the sense that there is no real short-term risk of a proper recession, I would say, in the Eurozone. We're just hovering just above the flotation line. And there are some countries which are doing very well. The southern countries in general are doing okay, more than okay. Spain is doing very well. So we're having issues with the core of the Eurozone. Germany has been in and out of GDP contractions for basically 2 years. France is having its own problems. But yeah, I would describe this as mediocre because I think the biggest issue we have is that although we have exactly the same dynamics as in the US in terms of wage growth being perfectly decent, outperforming inflation, so that should generate enough purchasing power gains to support consumer spending, it's not happening because people are saving too much. And that, at the moment, is the big difference between the US and Europe.
It raises a question about whether that's true in a policy perspective as well. In Washington, D.C., a lot of people are gathering to worry about the deficit. I'll be heading down to worry about the deficit with them. But there is a large question about whether the ECB and the central, just in general, the fiscal ministers of Europe should be more focused on reducing the deficit or more focused on trying to stimulate an economy that is kind of losing some of its levers of growth.
I don't think in any case, I don't think we have much of a choice here, in the sense that even if we're certainly, out of all the pressure we had on the peripheral countries, and that's good, we had an experience in Europe not so long ago in the UK suggesting that if a country goes too fast into stimulus, the reaction from the market is actually quite quick and quite painful. We should never understate the impact that the Liz Truss episode had on European policymaking. It has really been used as a lesson. So I don't think there's much of a choice here. My view here is actually, if we're lucky, and I think we might just be lucky, there is this change of tone from the ECB. I think they are readier than a few months ago to provide really a good dollop of accommodation, and that could just offset the impact of the fiscal consolidation. So we should be able to stay just above the flotation line. But deep down, I think the biggest issue, and it's being lost a little bit in the policy conversation, is that Europe looks at the US, and at the moment what the lesson they draw is, okay, just pour billions of dollars into the system and it's going to do the trick. And obviously it helps. But if you look at the structural forces of the US economy of the last few years, you've had this significant acceleration in productivity. It has nothing to do with the IRA. This is the product of corporate choices, investment in R&D, investment in softwares that happened 10 years ago. And by being, I think, to some extent, a bit overly focused on the need for additional stimulus, we're losing, I think, the sense that if you build a sound and proper business environment for your corporate sector, you might actually get the kind of productivity gains that you've seen in the US. And we are completely, at the moment, focused on the billion pouring side of the equation. It helps, but it cannot be the entire story if you really want to lift potential growth in Europe. We still have sources of rigidity. 10, 15 years ago, it was obvious to everyone that we had to reform. And now we are talking less and less about reform, more and more about pouring billions. And I think it's an interesting shift.
So put this together, because you're talking about how the Liz Truss moment kind of hangs over the ghost, the entire Euro region, which is a reason why there's so much focus on debt reduction, and yet you are seeing yields rise in tandem over the past few weeks, at least in the longer term, with the U.S. So do you believe that the divergence between the U.S. and Europe can truly grow, or do you think they're kind of tied at the hip because of these dueling priorities in Europe?
It can unfortunately grow because it's a bit the curse of European financial markets, in the sense that there's always been this dominance of the US market. So if growth in the US remains as strong, if inflationary pressures in the US come back a little bit, and we have long-term yields in the US coming up, there will be some contagion to European yields, even if honestly our proper fundamental situation is not consistent with higher long-term yields. And this has always been our problem. As long as the European financial market remains dominated by the signals coming from the US, we will always be at a disadvantage, basically. When the US is doing well, obviously that's good for our exports, but at the same time, it's usually detrimental to financial conditions in Europe. And we are a bit in the situation now. We should not overstate the case. I mean, we're talking about German yields staying between 2.25%, 2.5%. I mean, we can survive this. French yields 3%. We can survive this. I mean, it's not a situation which calls for alarm. But yes, normally we should be expecting even lower long-term yields. We're not having them. And yes, the situation in the US explains some of this resistance.
Can European exporters sustain a 10% tariff ring around the United States?
I would define this as unpleasant, but probably manageable. I mean, there would be a cost to GDP growth in Europe. That's obvious, but probably there are different estimates, maybe 0.3%, 0.4% of GDP. It's manageable. The biggest issue for me is the knock-on effect from a 60% tariff on Chinese products for two reasons. One, because you could have a very detrimental impact on Chinese demand itself, which would have a knock-on effect on our exports. And second, it may incentivize Chinese exporters to try to focus on the European market or to try to compete even harder with our products on third markets. If you throw into the mix the fact that one possible reaction of China to a 60% tariff would be to allow its currency to fall faster, then we end up at disadvantage yet again, because you would end up with an appreciation of the euro relative to the yuan. So it's the 10%. Obviously, everyone talks about it, but I really think the biggest issue is this 60% on China.
Everything you just said screams disinflationary shock on the continent. Like, screams it, doesn't it? It's each and every one of those 3 points.
It's interesting how the debate has moved from inflation is too high to inflation may undershoot. And I think it explains this change of tone from the ECB in the last few weeks. I think there is the sense, for instance, if you look at the list of arguments, the list of upside risks to inflation, 1-2 months ago, they were, for instance, talking about trade disruptions, aka trade tariffs, as, it could be a source of inflation. And now it's about, no, it could actually be a negative impact on demand, and that would actually be disinflationary in Europe. So, yes, this is aligning. The debate is changing in Europe, which is the reason why I think the ECB is really going to probably cut 25 bips every meeting until the middle of next year.
Gilles, appreciate it. Smart as always. Thank you, sir. Gilles Mowick there of AXA. The 3 points that Gilles makes there, I think the number one point is that we have overcapacity in China. We know they're exporting that overcapacity to the world, and if the walls go up in America, Europe's got to eat it. That's a major disinflationary shock. The additional points that Gilles is making, the currency channel, one, and the other one, ultimately the Europeans won't have a big source of demand, China, because they'll be weaker off the back of it. Again, just feeding into that disinflationary narrative.
Which is, to Gilles' point, the reason why maybe the ECB is going to change its tone and has been so behind the curve. Still, the focus has been on combating inflation, but if the worry is not having inflation that's high enough, well, that kind of changes the trajectory for potential rate cuts.
The euro right now, 108.16, just about unchanged. It was kind of rolling over, as Gilles was speaking, for obvious reasons, obviously, with the ECB cutting interest rates 25 basis points at every meeting for the foreseeable future. Let's talk about the bond market just briefly. A 2-year, 10-year and 30-year shaping up as follows. Big move higher worldwide. And I think that's a really important point that we've got to make this morning. This wasn't just a US move, it was a global move. You can say it started in America with that double-digit move on a 10-year at 418.38, but we saw it in Germany too. Similar size move, saw it in Australia as well. 16 basis point move, Bramo, on a 10-year in Australia, just overnight.
Well, this to me is fascinating because what you're looking at is essentially a global bond market, and Gilles was talking to this too, that really Europe is going to be subjected on some level to whatever happens in the U.S. if yields go higher, even if they're facing disinflation. So how much of a drag is that? How much can you actually see that divergence widen?
Back with us around a table, joining us right now, Jitanya Kandari of Morgan Stanley Investment Management. Jitanya, good to see you.
Good to see you.
Welcome back to the program. Over the last few months, we had one conversation and it's changed very quickly. So I'll go back to what the conversation sounded like maybe a few months ago. Yields were peaking, rates had to, and growth was going to start to decelerate. Now, all of a sudden, a few months later, we've turned that on its head all over again. Where are we now?
Yeah, so I think at this point, we are discounting the Trump trade, right, with inflation picking up, yields picking up. But I think I'd offer three perspectives that is a little different from what the market is saying today. One is when Trump came in power in 2017. That was a big surprise. Today, there is a 50% chance that he comes. So the reset post the elections is going to be less than what we saw in 2017. Second, with all this inflation getting discounted in the market, it's important to note that despite all the Trump tariffs since 2017, the export prices coming out of China are the lowest compared to any other market. So yes, there is excess capacity, there is an adjustment mechanism there, and so I think that's important to keep in mind. And the last thing I'd say is, even when tariffs were imposed on Japan in the 1980s and 90s for pretty similar reasons, which is automobiles and semiconductors, the yen took the brunt of that adjustment to offset the tariffs. So I think you have to kind of read outside of the obvious and what the consensus is thinking. So I mean, we are not really positioning one way or the other. But to your point, yes, growth has been much more resilient than people expected.
You said you're not positioning one way or another, but are you looking for dislocations that could emerge on the heels or ahead of the election that could be good entry points or selling points for overall theses that you have that are independent of the election?
Absolutely. So we're really studying all the impacts of the policies. One is, how does the deficit get funded between the two presidencies? One is through tariffs, the other is through taxes. So trying to understand that landscape. But it's still within the margin of error in terms of the 50-50 chance of who comes. So it's just being very nimble, the ability to act. And I think the biggest transmission from an asset allocation perspective is clearly how this manifests in the dollar and how that view translates into US versus ex-US, because the dollar kind of impacts a lot of the international markets. So definitely keeping all the outcomes in mind to kind of act, but not positioning one way or the other.
So when you look at the outcomes for the dollar, it looks like the dollar's higher under both, at least in the short term. But what about the long term?
So long term, we talked about this last time, that the dollar is expensive. But the dollar is not an emerging market currency that moves up and down 30% at one shot. So it moves within a 10 to 15% band if you look at it. So you could pretty much have counter-trend rallies in the US dollar, and the growth differentials and rate differentials in the shorter term determine that. That seems to be now favoring the dollar, but the longer term path is an international allocation given the expensive dollar view that we've had.
So you're advocating for a bigger allocation to EM equities. Is that fair?
I think we're looking at pockets of the world, international and EM. I mean, just an interesting point here. So the market cap of Apple today is larger than the entire market cap of UK. Or, there are these market cap of NVIDIA larger than Australia, right? The market cap of the Mega 7 is larger than the entire European market. So there are dislocations in the financial ecosystem that we are trying to, capture, and we're trying to be invested in. And yes, some part of it is in emerging markets, some part of it is in pockets of Europe, Canada, Japan. So we have a pretty wide spectrum of allocations across different countries.
You used a word that was important. You said dislocation. Some people might say it's just a fundamental rationale. The FTSE 100, not even 1% of it is information technology. 20% of it, as you know, is financials. Some people might say it makes a heck of a lot of sense that we see these big companies in America and we see these small market caps elsewhere across Europe. Why is that a dislocation?
Because I think the focus is so much on the Mega 7 and following the trend there that a lot of these different pockets of the markets are beginning to see some fundamental momentum. So if you look at even things like the industrial pockets of Europe. The domestic side of UK looks really interesting to us, given where we are in the economic cycle, in the monetary policy cycle, and also the fact that a lot has been discounted in the UK markets post the whole Brexit issues. So several pockets of the markets are dislocated, but also have a fundamental driver to unlock and to catalyze a move in those pockets across the world.
Thoughtful stuff. It's good to hear from you, as always. Thank you. Jitanya Kandari there of Morgan Stanley Investment Management. Just to get you up to speed on the equity market, we rolled over just a touch going into the opening bow. That opening bow is about 41 minutes away. Equity futures down here by 0.5%. With an update on stories elsewhere with your Bloomberg Brief, here's Danny Berger. Hey, Danny.
Hey, John. A federal ban has gone into effect, which prohibits the sale or purchase of online reviews. The FTC under Lina Khan issued the rule in August, but the agency can now seek civil penalties against those who knowingly violate it. The rule specifically bans reviews and testimonials from people who don't exist or are AI, people who have not engaged with the business or product, and those who misrepresent their experience. Elon Musk and Tesla are being sued by Alcon Entertainment. The studio says Tesla used imagery inspired by the 2017 movie Blade Runner 2049 at its recent robo-taxi event after permission was denied. Alcon also alleges that Tesla didn't reach out for permission until the day of the event. Musk, Tesla, and Warner Brothers Discovery, which hosted the event, are all listed as defendants. The Nike swoosh will remain a fixture on pro basketball courts for years to come. The Nike reviewed its partnership with the NBA and WNBA to serve as the league's uniform and merchandise provider until 2037. Nike will oversee the design and manufacturing process for both fans and players' apparel. Financial details of that deal have not yet been disclosed. And that's your brief, John.
Danny, thank you. Thanks for this morning. Up next on the program, we'll set you up for the day ahead. From New York City, you're watching Bloomberg TV.
Many global investors that aren't interested in China anymore, but there's a lot that are. And obviously the local investors have money in China and are doubling down on investing in China. Many of the Asian investors, and in fact a lot of the Middle East investors, the Americans are gone away. Therefore, there's an amazing opportunity to put capital to work and get returns which are excess what you would get in other places. Where there is lack of money, there is usually opportunity. So we continue to build out our business in China. It's just where the money's coming from is different. And so we're raising local money in China for investing and bringing those that choose to be there to invest in China. So it's just a different, where the money's coming from is just different.
Welcome to the world of decentralized finance.
We thought we'd take a look at Bitcoin versus the S&P 500.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
It's really a tale of two cities in crypto.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
There is this real momentum from Wall Street.
We're
basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
36 minutes away from the opening bell, equity futures near session lows were down by 0.5% on the S&P 500. In the bond market, pretty stable after yesterday's sell-off. 418.97 on 10s after breaching 420. To kick off the trading week, as we count you down to the opening bell, here's the trading diary of the week ahead. It's shaping up as follows. 10 a.m. Eastern Time, Bloomberg's Francine Lacqua sitting down with the ECB President Christine Lagarde. Do not miss that conversation on Bloomberg TV. Tomorrow, Tesla and Boeing report, plus the Fed's beige book coming at 2 p.m. Eastern Time. Thursday, another round of jobless claims, plus S&P Global PMIs, and we'll also get earnings from UPS, Southwest, and American Airlines. And on Friday, durable goods and humid sentiment. About 90 seconds left. Enough time for a final word. Final word, Bramo.
I want to see actually some of the earnings, in particular with UPS, because that used to be a bellwether. Yes, you do have competition from the likes of FedEx, but the earnings are going to get more and more interesting at a time where the other data is messy. And I think at a time where people are talking about no landing, hard landing, soft landing, and confused about the election, I want to hear what the company executives have to say.
Well, I want to see more confusion about the election. Kamala Harris is sitting down with Telemundo and NBC. Former President Donald Trump's in Miami and North Carolina today. It's the final push now. What are the latest promises going to be 14 days out?
I'm looking forward to the bonus edition of the podcast of this program where Lisa will tell you more about her toilet paper preferences.
Well, I think
that'll be released a little bit later this afternoon.
I think that a lot of people would agree. I think that there are small luxuries in life that you can go for, even if you're a student, and that was one of them for me.
Okay, just to clarify, there will be no bonus parts of the Bloomberg Surveillance podcast a little bit later. Coming up tomorrow, we'll catch up with Ben Gutteridge of Invesco, Alicia Levine of BNY Wealth. We'll speak to Senator Tom Tillis of North Carolina, and Francis Donald has a new seat. Looking forward to this. Congratulations to Francis Donald of RBC joining us tomorrow morning. Look out for that. Equity session lows on the S&P after a big sell-off to start the trading week in the bond market. Just a little bit of stability. Your 10-year at 419. Your 2-year just holding on to a 4 handle. From New York City, thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
What's it like moving from the East Coast, where everything is finance and money, to the West Coast, where everything is technology? Did you fit in right away? And did you really know how to use all the computer things that they give you to use?
So it was pretty fun. There were plenty of times where I would sit around in meetings, and literally I would be Googling terms. And at one meeting, Larry Page actually caught me Googling terms, and he kind of pointed that out to other people in the room, which was a little embarrassing, but I figured there were some things that I could do that they couldn't do. And so it was a learning curve. And my dad always, he taught me at a young age a term that I've used constantly with my teams. He said, in his lab at Stanford, if a physicist could not define a quark in under 30 seconds, they didn't know what they were talking about. And so I use the quark test all the time. If somebody's rambling on and they can't get to the point, they probably don't know what they're talking about. They fail the quark test. My finance team knows this quark test. And at Google, I'm working with amazing computer scientists, so they never fail the quark test. They can explain things really clearly, which shoots you up the learning curve.
But did you understand what they were talking about from the beginning, or did you have a special tutor that's taught you technology? Or did you?
I had actually run tech banking and took Google Public, so I had a little sneak preview.
Why does this business model work? Because it's virgin space. It's never been done before. and it'll never be done again. When you step back and you look at something that's been golf through institutions has been the way it has been for 53 years without change. In 1993, I stepped back and said, okay, this is not right. It's doing the same old Groundhog Day. Everything's the same. Players are a pass-through entity. They're not getting any equity built in their day. Once they're done playing, they're out. I thought, that's just not right. When you have to build a sustainable model, you need to have these players, these famous, the world best, the best of the best. You need to give them equity into the future. You need to give them a vision of where they need to go and how they're going to get there.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
We could see the second day in a row of losses after not having seen such a run in 30 sessions. 30 minutes until the start of trading, I'm Matt Miller.
I'm Shanali Bassick. And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
And coming up, setting your kids up for financial success. We're going to speak to Melody Hobson, the co-CEO of Ariel Investments, about her new book, Priceless Facts About Money.
And Bank of England Governor Andrew Bailey shares his thoughts on how to navigate the biggest risks in the global economy at Bloomberg's annual Global Regulatory Forum, kicking off this hour.
Plus, GM hitting the gas pedal in its latest quarter as high prices boost profits. We'll dive into the numbers, all that and more coming up. And let's take a look at markets. 30 minutes until the bells ring. As Matt said, of course, we are on track for back-to-back losses. We haven't seen that on the S&P 500 in 6 weeks. So we'll see if this downdraft holds. Currently down about 0.5% pre-market. A little bit more if you take a look at big tech. The NASDAQ 100 currently off by about 0.6%. A little bit of a rally in the bond market. We haven't seen that for a while. Of course, 10-year yields breaching 420, now coming down a little bit, but still relatively lofty, Matt.
Yeah, we were at 420 this morning. I am seeing a term premium in this market, and it's something that a lot of people are talking about. You're starting to see a steepening of the yield curve as investors worry about fiscal deficits and the debt. Remember yesterday, T. Rowe Price said we could see the 10-year yield over 5% in the next 6 months. So this is something that we're going to talk about again with Melody Hobson today.
4.2%, Matt. You know how I feel about that. Now, some stocks to watch as well. We're talking about General Motors, down now 10%. They beat earnings estimates and raised its profit forecast. Demand is improving, but that is just how the market feels, even about a beat. Also, 3M raised its full-year profit target. Its new CEO boosting productivity for the industrial giant, now up about 4.7% pre-market. Danaher down 2.6%. It topped estimates this morning. But to the downside, we're watching even more downside still. We're watching GE Aerospace dropping. Supply chain limitations are weighing on deliveries. Now General Electric down almost 6%. Verizon also down after reporting mixed earnings and lackluster sales of new smartphones. The likes of iPhone 16 here, 3.6% lower pre-market. Lastly, Kimberly-Clark down another 5%. It cut its outlook after a revenue miss, and stores have lowered stocking levels for products. Matt, brutal day of earnings today.
Yeah, it's brutal in here. Speaking of cutting outlooks, the IMF lowered its global growth forecast for next year and warned of accelerating risks from wars to trade protectionism, even as it credited central banks for taming inflation without sending nations into a recession. It raised its forecast, though, for the U.S. In fact, the U.S. Was one of only 2 countries for whom the IMF raised its forecasts in 2024 and 2025, South Africa being the other.
There you go, 2 peas in a pod. I do think, of course, that's the good news, but you have to squint for it in this forecast. Of course, 2024 global growth is unchanged. That's expected at 3.2%. Then you look ahead, doesn't look too great for 2025, but like you said, actually upgrading the U.S., it sees 2025 GDP growth at 2.2% for the United States and South Africa, too.
It's interesting. The elephant in the room here, the elections, the U.S. elections are not mentioned in this report. but the meetings themselves are 3 blocks away from the White House. And not to mention the report itself, it does talk about protectionism, protectionist policies, and trade policies. Of course, that is a large aspect here of the U.S. political elections. But of course, according to this report, it is impacting more of the rest of the world, Matt, instead of the United States.
In fact, you shared a full screen earlier. I'm sure we'll have it and share it with our viewers at some point that breaks down the countries lagging and that are ahead. Mexico is a real trouble spot, and you have to wonder how much that has to do with this presidential election. Let's bring in Samir Samana from Wells Fargo Global. He's a senior global market strategist at the Investment Institute. Samir, thanks so much for joining us. What's your take on growth right now? I mean, it feels pretty strong. Katie just said 3.2%, is better, I think, than the long-run average. How does it look to you?
Yeah, I mean, to your point, I think it's at a steady state, right? I mean, we went through kind of that EKG, as we call it, right, in terms of, the big drawdown into COVID, then the sharp, snapback thereafter, and now it's, kind of getting back to, probably the norm from kind of the 2017, 2018, 2019 timeframe, and it's more than enough for companies to generate profits. I think probably what would be, very surprising to a lot of investors is that, in 22 and 23, when, growth was pretty good, profitability wasn't all that great because you had supply chain disruptions and you had, a lot of things you were still working through. Now, as growth is slowing, what you're seeing is profitability is picking up, and earnings should have a really solid 2024, and then they should continue that into 2025. And that's what we think will kind of power equity markets, higher, beyond the elections.
I'm curious how you would build a portfolio around this report that we got from the IMF, because as we walked through, I mean, globally, that forecast for growth coming down, the U.S. actually getting a little bit of an upgrade here. We've seen that the U.S. has been the standout in global equity markets. Is that still going to be the case?
Yeah, great question, Katie. And we've favored the U.S. now for years. And again, it has to do with, one, just kind of the systems in place in the U.S. Two, I think it has to do with, just the great configuration of companies that are geared towards tech and tech plus in the U.S. And, from that standpoint, it's just very difficult right now to say that will kind of shift. We're watching for it, but again, we're very skeptical right now. If anything, Europe's actually getting worse. Some of those downgrades to Germany and Italy, I think, are very much warranted. So we would still favor U.S. large caps. I think it's still very much a winner-take-all economy. We did, however, take the opportunity early August to upgrade small caps to neutral. Again, we do think there's some two-way risk there, and we remain unfavorable on emerging markets. Despite some of the measures in China, we think over the long run, it'll be very difficult as an investor to generate positive returns above those other equity asset classes in the emerging markets.
I want to pull up also this note from Citigroup this morning, this idea that you have investors looking particularly extended, particularly when it comes to futures markets. So through derivatives, people are positioning ahead as things have nowhere to go but up, Samir, for the lack of a better way to say it. How much risk is there at these valuations, even if you like those large caps?
Yeah, great question. I would say there's quite a bit of risk, and we've been saying for some time this is a great time to rebalance, especially with yields perking up north of 4%. We recently took advantage of the move in yields to actually get a little bit more constructive on the longer end of the fixed income curve. We were unfavorable. We took the opportunity to go to neutral. So again, starting to kind of lengthen that duration a little bit. If we see 4.25, 4.5, I think we'll probably continue to tilt in that direction, because when you have kind of starting valuations where they are right now, could you generate another, 6, 12, 18 months of positive returns? Absolutely. But then kind of that cyclical to strategic, outlook does start to get a little bit more cloudy with those starting valuations. So what we would say is this is a great time to immunize those portfolios by tilting a little bit of money from equities probably into fixed income, in a rebalancing type of fashion.
What about, steering away from the sectors that have done so well, from the big tech, for example, and buying into those that haven't done as well? How do you feel about smaller cap stocks?
Yeah, so we got a little bit more constructive there. I think neutral is the right place to be. I think the fact that they're just still struggling so much in the economy that, as it currently stands, with respect to the non-earners in the Russell 2000, I believe are in the neighborhood of 40 to 45%. A lot of private equity, firms are taking some of the higher quality, smaller caps kind of off the board. So you just have a very kind of, mishmash of kind of smaller companies that are in the Russell 2000 at this point, which is our benchmark. So neutral is probably probably the right place to be. We do like energy. That's our most favorable sector. It's a great hedge against inflation coming back, against geopolitics. We also like industrials, financials, and communication services. So very much a cyclical portfolio, maybe not as geared towards technology. And then we don't like staples and we don't like utilities. Those are areas that will continue to struggle due to higher commodity prices, due to higher interest rates, due to higher inflation. So we're, you know, I guess kind of our mantra right now is anything but defensives is the way to position.
And Samir, we don't often do this on this show, but I do want to talk about the bond market a little bit, since you said that you've taken opportunity of recent moves to maybe get more favorable on the long end. You take a look at the 10-year Treasury yield. It's higher by nearly 60 basis points since the Fed cut rates in September. That is the biggest post-Fed rate cut move since the Fed cut rates in June 2003, if bespoke research is to be believed. What do you make of that? I know, of course, that you're adding here, but where do you think fair value actually is?
Yeah, I mean, it's not surprising given the fact that the Fed was largely doing what they termed as a risk management move. You know, I mean, it's just common sense, right? If you take the risk of a recession off the table, which is what a risk management move is, then by default, you should see the longer end start to kind of, you know, creep higher because, again, they tend to do best when there is, you know, slowing growth and or a recession. So, you know, I would say here kind of in this 4 to 4.25 range probably is fair value. You know, where would things get really attractive or interesting? I would say, you know, not too far from here. I would say, you know, again, we started to lengthen now, but 4.5 to 5, you know, I know there's some out there who see 5%. If we were to see 5, we would be in the camp that you're not going to see it for very long, and you should absolutely take advantage to make sure you have your duration kind of on the longer end. Not here so much, but especially if you were to get to 5.
All right, Samir, always great to speak with you. Appreciate your time this morning. That is Samir Samana. He is Wells Fargo's Senior Global Market Strategist. Meanwhile, a quick check on these markets. Less than 20 minutes to go until the opening bells, and boy, it's ugly out there. The S&P 500 down about 0.6%. Of course, that volatility coming through, mainly in big tech right now, with the Nasdaq 100 currently off by about 0.7% pre-market. Your small caps faring roughly the same. The Russell 2000 currently lower by about 0.5%. Now coming up, one of the most powerful women in business, Melody Hobson, joins the show to talk about financial literacy, market volatility, and the election trade. That conversation up next. This is Bloomberg.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
Why does this business model work? Because it's virgin space. It's never been done before, and it'll never be done again. When you step back and you look at something that's been golf through institutions, has been the way it has been for 53 years without change. In 1993, I stepped back and said, okay, this is not right. It's doing the same old Groundhog Day. Everything's the same. Players are a pass-through entity. They're not getting any equity built in their day. Once they're done playing, they're out. I thought, that's just not right. When you have to build a sustainable model, you need to have these players, these famous, the world best, the best of the best. You need to give them equity into the future. You need to give them a vision of where they need to go and how they're going to get there.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
While the majority of Americans own stocks in retirement accounts, only 34% of those surveyed by the Fed said their plans were on track. And famously, nearly 4 in 10 Americans have enough cash saved up to cover a surprise $400 expense.
Don't have enough cash.
Yeah. And we don't learn nearly enough about saving money and investment in this country, but Melody Hobson hopes to change that. Melody Hobson is the co-CEO of investment firm Ariel Investments, out with the New York Times best-selling book for children, Priceless Facts About Money. Hobson is also on the board of Bloomberg Philanthropies, the philanthropic organization of Michael Bloomberg, the founder and majority owner of Bloomberg LP, which owns Bloomberg News. And thank you for joining us here, Melody. You know, this book in particular, you start with your own experience growing up in Chicago with a single mother who sometimes was looking to make ends meet. Now you stand on the board of multiple boards of Fortune 500 companies. In a lot of ways, is this book very personal to you? Is it a memoir of some sort?
It's not a memoir. I thought my story was very important in the beginning to grounding the book, but I also shared John Rogers' story, who founded Ariel, just as a beginning, setting the stage of why the book makes sense and inviting the reader into our lives as we were children, you know, explaining what it was like when we were children. For me, money was such a big deal when I was a child because we had such a hard time making ends meet that I felt that letting the reader know why money became so important to me as a subject matter was something that they would then appreciate my passion for the subject.
You know, something we were talking about was this idea that only about half the states in the United States really teach financial literacy, require it when you go to school. How might that change over the next couple of years? Do you think that there could be a bigger push here to get financial literacy taught in schools?
I'm hopeful. I don't know that there's any trigger that will lead to that. I was really happy to hear that the state of Maine actually bought my book for every elementary school student in the state. I was astounded by that, and I thought, that's great, because we want children to have this knowledge, and honestly, I want the children to be the gateway to the parent. I'm hoping a lot of parents will pick up the book and be astounded by the facts that they read and think, I need to do more and learn more, because most of our money habits are learned from our parents.
Right, and most parents don't talk to their kids, don't feel comfortable talking to their kids about this stuff. I know mine didn't. So that's a piece, the book is a piece. Hopefully getting it into schools is another piece of it. Is there a holistic, a healthy model? Can you look to another country, another civilization and say, they've done that right and we need to sort of adopt those practices?
I wish I could. The world is pretty financially illiterate. The subjects of money and investing, other than counting, we don't go very far in schools in most places. And I know there are things, home ec and classes like that, but I think we need to go a lot deeper, really understand the fundamentals of the stock market and investing. When you think about the fact when you get your first job, you look at that 401k plan and you have to make decisions that ultimately affect your family's financial security over the long term in terms of your retirement. And no one's really trained you to think about how to make those decisions.
Yeah, and hopefully you're doing that when you get your first job, because it took me over a decade before I finally started to invest my earnings. You know?
Well, so many companies now are automatically enrolling their employees, so that helps a lot. That inertia, once you get into that plan, you keep investing. That's a great thing. We have to make sure when people change jobs, the average American has 13 jobs in their lifetime, that they don't change jobs and cash out every time that they move. And there's such interesting data about that. The Wall Street Journal did a great story yesterday on it about the fact that the smaller the amount you have in your 401k plan, the more likely you are to sell it. The bigger the amount you have, the more likely you are to roll over.
Yeah, it's fascinating. And the experience of switching jobs and seamlessly getting your 401k across, still a clunky process. But with this book, what I think is interesting is that, of course, you go into the history of money thousands of years back. But I'm curious if you thought about future-proofing this at all, because you walk through a sample bank transaction. Do you think things could look different in 20, 30 years when the children who are reading this book are actually applying these lessons?
Well, we hinted at some of it. First of all, I don't think knowing the history changes anything. doing. I think that's actually great and really important, and it's fascinating. I mean, just explaining things like, you know, precious metals are the results of meteors hitting the Earth's surface. I mean, most people don't think about that, or fossil fuels, or dinosaurs. You know, there are lots of things there that I think no matter who you are, whatever time we're in today or 30 years from now, but will be great. I hint at some of the things to come, and I talk about, for example, paying with your phone, and hint at some of these other things, and I think that we will see. However, it doesn't change some of the fundamental ideas that I think are important. For example, I'm encouraging parents to use cash around young children, because these concepts are incredibly hard to understand. They're mystical when you see money spewed out of a machine like an ATM, or you see your parents only paying with plastic. And so a lot of parents will tell me their children will say to them when they say, we can't afford this, put it on a credit card, which suggests they don't understand the fact that the credit card is something you have to pay, or that money is finite. So no matter where we are with how money and exchange and all of these things work, decades from now, hundreds of years from now, I think this foundational information is still very important and probably very evergreen.
Or the concept of a 25% interest rate, right, for the credit card. You know, it's interesting. Goldman came out with a note in the last couple of days saying that the next 10 years for the S&P 500 might not be as good as the last couple of decades. If you are a young person investing $1 today, if you are worried about the next 10 years, how do you think about investing?
So first of all, I think that that's a nuanced argument that Goldman is making. I saw the report, and I think top line, they are right. However, the driver of the S&P over the last decade, as we all know, has been a very narrow group of stocks. We know the Mag 7 has had an outsized effect on the returns that we've seen there. And so I often think we have the S&P 500. It's really the S&P 493, and then the Mag 7 that has turbocharged those results. So I would say I'd like to be a bit more nuanced in thinking about that return in the future. And I think there are areas of the market that are very undervalued, where we have the opportunity for real appreciation over the next decade. If you look at how smaller company stocks have done versus large cap, the Russell 2000, or where we live at Ariel, the Russell 2000 value versus the S&P 500, there is a gaping hole in valuations right now. And we think, therefore, there is a tremendous opportunity for smaller cap stocks to have returns that are more like what we've seen historically if you look back to 1926.
Before we get to the small caps, and I know
I'm itching over
Katie
here.
champions the small caps for us on this program.
Yay!
I just want to know what your take on that report, because I feel like if we're kicking off this decade with NVIDIA, you know, and Facebook and Microsoft and Amazon and Alphabet in the S&P, that's a great start for this decade. And then if you get OpenAI and SpaceX and start adding these innovative companies, I mean, it seems so pessimistic for Goldman Sachs to forecast only a 3% annualized rate. As we showed on the chart that I cribbed from DataTrek, that has only happened like in the Great Depression or the financial crisis. I mean, only when horrible catastrophes happen do we get returns that low for a 10-year period.
And that's why I say I'm not necessarily convinced. However, the stocks that you mentioned, I think they're priced for perfection. I think you can be a great company, and I mean great, and not necessarily a great stock. And I think it presumes that everything goes perfectly. And I think that is very hard to accomplish over long periods of time. I was very humbled when I read stories in the last few weeks about Boeing and Intel, where you see what is happening there. When I came out of college, Intel was the Microsoft, the NVIDIA, the Andy Grove was, you know, superstar, legend. So the idea that that company is a $100 billion market cap, I never would have anticipated that. And yet, that is where we are, because life happened along the way. So again, you can be a great company and have things happen. I'm not suggesting any ill will on these businesses or these companies. I'm just saying from here, if I'm, as we are at Ariel, looking for value, I would look elsewhere, because the risk of owning the names does go up with these valuations.
Right, so the margin for error is super narrow if you're one of these huge, magnificent seven.
I mean, I read the story about, you know, Tesla having a $6 trillion market cap at some point. You have individual stocks that represent the market cap, one stock of the entire Russell 2000. I can't even wrap my brain around that.
Yeah.
And in terms of what that means, the kind of stocks that have been orphaned along the way, and therefore the opportunity that exists. And the concentration takes the risk up. The S&P 500 to me is a large cap growth index now.
Well, let's build on what you were saying about small caps, because we were having conversations yesterday about, one of our guests said that small caps are in a secular bear market. And part of the reason why is that you have high interest rates, you have these companies with big debt burdens, and many of them in the Russell 2000, just the normal one, for example, are unprofitable. So talk us through your base case there, how you're able to square that circle.
So I don't think that has changed from what we've seen in the Russell 2000 historically. Many, not all. There are great companies in the Russell 2000 Value Index that are not unprofitable businesses, that are wonderful businesses that have great potential over time. But the market has basically ignored those stocks, and therefore there's been no action in them. But it doesn't mean they don't have great futures. There are companies that do things that are very specific. Just because you aren't a T these days, a 1T, a 2T, a 3T, doesn't mean you don't have a wonderful niche business that can grow. And we have many of those in our portfolios, from cruise ships to, you know, all sorts of consumer products companies that are the best at what they do.
So, you know, another thing on the near term, I know we're thinking about long-term investments here as well, but we are just really days away from the U.S. election. The elections are on the top of minds of many investors at this juncture.
2 weeks from today.
2 weeks from today. My gosh, it's a heavy reminder. And so how do you think about the election and the impact it would have on the markets?
It's interesting. I think that it weighs on a lot of people's spirits and their psychologies. But at the end of the day, I've bought into our idol at Ariel is Warren Buffett. And Warren Buffett has been known to say markets are stronger than governments. And so I think that we've seen that time and time again. If you look back over the last couple of decades and seen the different leaders that we've had run the United States, the market has not been felled by any one person. And I think that's a testament to the fundamentals of the U.S. economy, and that ultimately that is what will drive returns. So while there's a lot of talk about markets and what will happen as a result of who wins, I think I'm more confident, and I'm a long-term investor. We have a turtle as a logo. I always have my turtle. I'm more confident in the long term that the U.S. economy will do what it always has done, and the American capitalist system will work.
So I also want to ask you about Kamala Harris for a minute here, because I know that you've personally signed a number of letters that have come out in support of her. What is it about her that you think that the business community may not be understanding? There are a lot of Republicans who will come out and say that she is not the best for business. What would you say to that?
I think she's probably more moderate than people think. I think there are a lot of assumptions that are made by association. I think one of the things I've been, you know, very confused by is this idea that you be a clone of another person that you work for or with. I was president of Ariel when John Rogers was CEO for many, many years. We are now co. We are very different leaders, but we are aligned in our core beliefs around values. We make different decisions all the time, and that doesn't make one of us better than the other. We're different. And so I think that when she's in the top seat, when you are the boss, it's very different than working for someone. And technically, when you're vice president, you work for someone. So it'll be, I think the assumptions that are made about who she is, those are yet to be fully revealed, but I am encouraged by what I've heard so far.
You know, we talk a lot about the things that are wrong with this country, and Harris and Trump talk about that too, and we really focus on the risks. I wonder, you know, with a book like this, looking forward, hopefully with hope, what does the U.S. do right? I mean, you've had such success in your career, and the companies that you foster have had such success, I imagine in large part because of the U.S. environment. So what does this country do right?
Oh my gosh, we do so many things right. I love America. I think we are the best country in the world. And that's not based upon some manifest destiny point of view. It's just the facts of, if you look at just at the market level, people want to be invested in the U.S. That's where they see the opportunity. If you look at some of the quintessential American things, hope. Americans are always very hopeful. I think that's a wonderful way to be. If you look at things like charity, We are the most generous nation in the world. Literally, no nation comes close to us in terms of looking after each other and giving back to our society. If you look at opportunity, despite the fact that people do not yet have the full opportunity that I believe they should have, especially those who are Black and brown and those who are women, we are not yet fully at the table in any way. Despite that fact, we are still better positioned than a lot of other places in the world. And you can be me. You could be someone who grew up the youngest of 6 kids, whose mom was struggling all the time, who got evicted and cars got repossessed and phones got turned off. And you can go to Princeton and you can be on the board of Bloomberg Philanthropies and on the board of other companies, and you can run an investment firm. Now, there was tremendous hard work that made that happen, but there were some unique aspects of America and what makes America great that allowed luck to come together there as well, and for me to happen. And I think there's the idea that we could have more melodies is what this book is about and what our country is about.
Is there a warning kind of under the surface here, too, about as we kind of get into this recovery era? Do you worry at all, Melody, about a K-shaped recovery?
I mean, again, we're bottom-up stock pickers at Ariel. You could spend a lot of time worrying about a lot of things. I have this quote that says, worrying is like sitting in a rocking chair. It gives you something to do, but it doesn't take you anywhere. I try to just think about what I can control, what I can do, and we try to have, at least at Ariel, in terms of our portfolios that are resistant to different types of economies.
All right, Melody, that's a good place to leave it. Really appreciate you taking the time with us today. That, of course, is Melody Hobson, and her book, Priceless Facts About Money, is available now. Meanwhile, we are 15 seconds away from the opening bell, Matt, and it looks like we're going to open on a down day.
Yeah, it does. And after a down day yesterday, so as you were pointing out at the top of the show, if we have red arrows here at the close, that'll be the first time we've had back-to-back losses in 30 sessions or in 6 weeks. You heard the opening bell there at the New York Stock Exchange, LATAM Airlines ringing the bell there. Interestingly, we have Chicago Atlantic BDC. I say interesting because Melody obviously comes from Chicago, ringing the bell down at the NASDAQ. Let's get a look at how the major averages are shaking out. And we have a ton of earnings today. They're going to move the needle. You have General Motors beating expectations. You have General Electric disappointing a little bit. So how will that shake out? And obviously, we've seen some volatility throughout the session, Katie, but what are we looking at right now as the live trade kicks off? Right now, about 40 seconds into the U.S. trading day, it's shaking out to the downside. You have the S&P 500 off by about 0.4%. We were down 0.5%, 0.6% pre-market, so holding these losses right now. Same thing, too, if you take a look at big tech. Really, you're laggard in this market, down about 0.6%. Small caps, relatively resilient, but still a down day, down about 0.3%. And we know that we had losses yesterday, and it was the small caps that led those losses. So we'll see a lot of daylight between now and 4 p.m. But let's take a look at what's going on at the single stock level. And we start with 3M, raising its full-year profit target for the second time under its new CEO, who has helped to boost productivity for the industrial giant. You can see that boost to shares right now, currently higher by about 3.5%, Shanali.
Also, Katie, keeping an eye on GE Aerospace, another company out with earnings now down almost 6%. Shares are slipping as supply chain limitations weigh on deliveries for the jet engine maker, Matt.
All right, yeah. That's an interesting report. We're going to dig deeper into that. I'm obviously focused on the other general in the room, and that's General Motors. Raising its profit forecast, at least the bottom end of its profit forecast, because demand has improved in the U.S. for the high-margin vehicles that it makes, the big trucks and the SUVs. Those are offsetting the losses that General Motors has seen in China, and they're also not doing as badly, I think, as everyone else with their EV strategy. We're going to get back into that in just a moment, though. Right now, I want to turn to the Bloomberg Global Regulatory Forum. There, the Bank of England Governor Andrew Bailey is giving the keynote address, and it looks like they're all getting settled in. We'll bring you any updates that we have from this forum from Governor Bailey as they cross the terminal, and you can also, I imagine, watch it if you have a Bloomberg terminal in front of you on Live Go. So type L-I-V-E Go if you want to hear from Andrew Bailey.
I'm sure many people do. So, of course, we have the terminal functions to do that. We'll continue to track this market as well. Really interesting juncture in markets, of course, on track for back-to-back down days for the first time in 6 weeks. We'll be back in a moment. This is Bloomberg.
Bloomberg's Open Interest is brought to you by Interactive Brokers. Invest globally in stocks, options, futures, currencies, bonds, funds, and more from one unified platform.
Markets never sleep, and neither does Interactive Brokers. Discover more opportunities with CME futures across equity indices, interest rates, FX, energy, agriculture, and metals. CME futures offer around-the-clock access, deep liquidity, and capital-efficient margins, helping you seize opportunities whenever they happen. The best-informed investors choose Interactive Brokers.
At Consumer Cellular, we pride ourselves on getting you the exact same nationwide coverage as the leading carriers for up to half the cost. But don't worry, we've got a lot more than that going for us. Woo! Like this beautiful store in Arizona, for example. It's the perfect place for me to tell you a little bit more about our phones and how they can become your phones.
The pandemic, we lost a tremendous amount of experience. A lot of skilled people have left the industry. We have to hire new people. The supply chain has to hire new resources and train the people, educate them.
And because those roles are filled now not by a 58-year-old, but perhaps by a 28-year-old, there's a lot we have to do in terms of not only adding capacity, but capability to meet the ramp that we all are embarked upon.
We have thousands of suppliers, and when you have just a couple of them, few of them that are late on the ramp up, well, that's slowing down everybody, and that's what we've been facing earlier this year.
Nobody covers business like Bloomberg. Context changes everything.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
As we spend some time here on the broader presidential race,
let's focus in on European politics.
Makes you wonder how politics might play out.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
All right, we want to get you back with great anticipation to the Bloomberg Global Regulatory Forum, where the Bank of England Governor Andrew Bailey is giving the keynote address.
An approach that becomes more like a sort of disaggregated laundry list of potential risks. Macroprudential policy must focus on the system-wide risks, taking into account correlations, concentrations, opacity, interconnectedness. It's actually a more ambitious and harder to pull off approach. It tends to wane as a tool in its popularity as a tool, and as Klaus was making this point, as memories of the most recent crisis fade. And you tend to see a reversion to the more list-like approach. And I think we have to lean against that. We do have to keep this focus on system-wide risks and ground what we're doing. So, my first message today is that I think taking the macroprudential approach matters. It's harder, but it matters. Second message, come back to Cassandra. So Cassandra was fated by the god Apollo to utter true but unbelieved prophecies. In FS speak, she was dedicated to one tale of the distribution. She may have missed her vacation as a central banker. Maybe the disbelief was because, as Minsky would have said, memories of financial crises, memory of any crisis fades fast. And as Klaus said, I'm afraid this is evident now in the memories of the global financial crisis 15 years ago. Memories are fading. people sometimes say to me, well, you've solved that, we can relax. But the work of theory and history is timeless, and it warns us, actually, you can't fall into complacency. We must always debate levels of regulation. That's the right thing to do. The debate about growth and competition is the right debate to have, but we can't ignore the timeless nature of financial stability. That's the second message. The third message really focuses on the critique Minsky made of what was actually post-war Keynesian economics, though not actually Keynes himself, and the point that money and finance matter together because of their interaction and its potential to cause instability. Now, before the global financial crisis, there was a debate that centered around a question that was much too limited, which was, were we in a world of asset price bubbles or not? That sort of ignored all the interconnections. Now, as Klaus said, since the crisis, the global scale of bank and non-bank finance has shifted towards the latter. And so again, as Klaus said, rightly, we've had to shift our focus. Now, we've increased bank regulation. That was an absolutely necessary thing to do coming out of Pittsburgh to reflect the crisis. But macroprudential risks in the non-bank sector have not originated just because of the shifts we've seen in the last 15 years towards it. They were there in the 19th century, actually. So this is a lesson that we've seen before. But the shift, and this is the third message I give, that relative shift towards non-banks since the financial crisis makes these risks more pressing, even though they're not new. Now, the non-bank world and its interaction with banking, money and finance, has evolved in ways that require us to look beyond regulation to surveillance and the tools of remedy. So my fourth point is about surveillance. The non-bank sector is large, it's disparate, it's opaque, it has complex and hard to observe interlinkages, it has hidden leverage, as Klaus was saying. In the banking sector, one of the big tools we developed after the crisis was stress testing of banks. Those stress tests are institution-specific, though they actually, in doing so, we seek to capture system-wide risks. But in the non-bank sector, we have to focus, in the spirit of Minsky, on how risk spreads, to identify the points of weakness in markets, in infrastructures, and in firms. And issues like leverage are the way in which those weaknesses become apparent, but it's the spread, it's, if you like, it's the flow of risk that we have to be more focused on in the non-bank world. So at the Bank of England, we're conducting our first, what we call system-wide exploratory scenario, which is designed to do this. It's designed to simulate shocks and observe their effects as they flow through the system. It's not institution-specific in that sense, it's a flow test. We're going to report the results by the end of the year. So my fourth message is, I think we are reaching a pivot point where, and I thoroughly endorse Klaus's point that we've got to implement the remaining rules and regulations, but we also need to develop better surveillance tools for this world, where flows matter and points of blockage matter. Now, you'll be pleased, I hope, to know that my fifth point is the last one. And that's about the tools that we as authorities use in a crisis. I made the point earlier that surviving extraordinary crises can require extraordinary measures. And sometimes we have to solve short-run situations with measures that are not consistent with long-run stability if they continue to be used. But they are necessary nonetheless. You have to do what you have to do, as Klaus said. Central banks provide last resort liquidity to the banking system. That goes back, of course, a long way in history. Now, that liquidity is rightly focused on the banking system. Its money is unique. Money must hold its nominal value. What I call the singleness of money, whether it's provided by the central banks or it's in the commercial bank system, holding those two things together with constant nominal and real value is absolutely crucial to the centrality of the money system. And so if a central bank injects money into the banking system, it's to do that. Now, historically, it's also because we believe that if we inject money into the banking system, it will, I think to paraphrase the Heineken advert, reach all the parts that are needed to be reached. Now, I think that the proposition that there is a unique and powerful relationship between central banks and banks holds true throughout. The third point I made, I think it was the third point I made, will injecting money into the banking system always reach all points where it's needed, I think is much more open to question. Now, I'm not going to talk a lot about LDI, contrary to Klaus's invitation, but that was one of the key challenges we had in that case. It wouldn't have worked. So I think the growth of the non-bank sector has given us as central banks the challenge. How do we meet that challenge? How do we meet that challenge in extraordinary circumstances of getting liquidity into the non-bank sector? But we do not compromise the fact that the relationship between central banks and banks is unique in terms of the value of money. What that means is banks are always able to come to the central bank for liquidity. Non-banks don't have a right to come to the central bank for liquidity, but there are times when we have to provide it. And I think we've learned that we have to provide it on a more systematic basis as an emergency tool. In other words, we have to say, this is what we will do if there is an emergency. And in saying that, we then have to be prepared, in a sense, to be good to our word, when we judge there to be a crisis. And so that's, again, to finish, what we're doing at the Bank of England. We're designing tools and putting them on a more, if you like, consistent basis to say these are the tools we will use for non-banks in a crisis, but they are not standing tools of liquidity provision in the way that we do it with the banking system. So to sum up, we have a very big agenda. We have made a lot of progress, but I agree with Klaus, there's a lot to do, and we cannot let the fading memory of the crisis take away the importance and crucial nature of financial stability. So just to summarize very briefly my messages, system-wide matters must not be overlooked. We must heed the warning that memories of past crises fade. The shift towards non-banks presents renewed challenges.
All right, and you've been listening to Bank of England Governor Andrew Bailey at the Global Regulatory Forum. If you want to keep listening, you can go to LiveGo on your terminal. But meanwhile, let's get a look at the stock market. Of course, we opened 15 minutes ago, and we are still in the red here. The S&P 500 currently off by about 0.4%. The NASDAQ 100, your big tech stocks, coming back a little bit, but still down about 0.3%. Your small caps, of course, a wipeout yesterday, currently off by about 0.4%. A pretty broad-based sell-off right now. If you take a look at the sector level, you have 3 sectors that are higher. 8 are down right now, being led by a downdraft in industrials, materials, utilities. Your lone bright spots, of course, are consumer staples. You also have communication services and energy fighting to stay green right now, Shonali.
It's fascinating. A tough start to an earnings season. Of course, we have even more next week, but we're going to bring you a positive story. We're going to talk about GM next. Out with strong earnings, biggest gainer in the S&P 500 right now. We're going to take a look at the automaker next. This is Bloomberg.
Earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Good morning. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets. Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Welcome back to Bloomberg Open Interest. A quick check on the market right now, of course, on track for back-to-back down days for the S&P 500. Haven't seen that in 6 weeks, and those losses certainly holding right now. The S&P 500 currently off by about 0.4%. Big tech going back and forth, currently down right now. The NASDAQ 100 lower by about 0.3%. And your small caps fighting to recover from yesterday's wipeout. Not exactly getting there. The small cap Russell 2000 index currently off by about 0.4%. Really broad-based selling going on at this moment. But it's time now for our top calls. Some of the analyst action in focus this morning, and we start with Bernstein, naming Walmart as its top pick in the U.S. retail category as it launches coverage of 7 companies in the space. The analyst says that Walmart will be one of the few retailers that can grow e-commerce profitably. Keyword profitably. Next up, Citi upgrading First Solar to a buy. The analyst says that the upcoming election is a catalyst for the stock, and if a Democrat wins, it could drive a sharp recovery in shares, while a Republican win would likely drive higher tariffs, resulting from a longer-term recovery. You can see shares currently higher by about 4%. And finally, we have BTIG saying that Decker Outdoors is no longer a buy, downgrading the shoe company to a neutral. The analyst sees slower start to the holiday season for its UGG brand, as well as moderating growth for its Hoka footwear as competitors catch up. Shares currently off about 2.3%, Matt.
All right, interesting note on Decker. I know that you have a Hoka story.
Many Hokas.
Yes, and we'll talk about that at some point. You know, we're going to get the CEO here and talk about what makes those running shoes better than other running shoes. One of the stocks we're watching this morning is General Motors. The stock jumping after the automaker showed solid demand for its highest margin vehicles, the trucks and the SUVs. GM also lifted its 2024 earnings, the bottom end of its range, to $14 billion from $13 billion in terms of EBIT. Here with more from Detroit is our bureau chief there, and he covers General Motors for us, David Welch. David, once again, GM beats, and it's been outperforming all year. In fact, over the last 2 years, outperforming the other American automakers, Ford and Tesla. What are they doing right? What do investors see here that they like so much?
The company is a cash machine. They have a solid product lineup, very good in some places, and they're getting, evidenced by the fact they're getting very good pricing. So look, in the quarter, GM sales were down 2%. A lot of that was at the fleet level. So retail did very well, and that means you get better pricing there. GM's average discount, I think, was 4.5%, and the industry was 6%. So while you're starting to see more discounting, largely because consumers are hanging back, waiting for interest rates to come down, GM did less of it. So average vehicle selling for more than $49,000. That's pretty expensive stuff, and they're making good money with it.
I was just going to ask that because it's interesting. If you look at the biggest gainer and decliner in the S&P 500 today, you have GM really on a tear today, but it's actually another auto parts maker that is the worst performer on the day. And I think it really speaks to what you're talking about, people delaying these big ticket purchases and a lot of weakness in the economy still. It's genuine parts that is down more than 18%. Why is GM able to stave off some of the storm at this juncture, David?
I think it's really kind of a lot of basic blocking and tackling. They've done a solid job of reducing costs. They said they were taking out $2 billion in structural costs, and they say they're going to hit that. And when you keep pricing up, that's a function of not producing too many vehicles, right? If you have too much inventory, then you have to kind of come up with a bunch of bribes to get consumers to come in and drive the stuff away, and they haven't had to do that. Stellantis has had to do some of it. We'll see where Ford ends up on that. Ford's actually done a fairly good job of maintaining price too, but right now that's where GM's growth is coming from, because they're having a tough time in China and also South America, the other market where they're pretty big, and the U.S. is where they make all of their money. So even if volume's a little bit down, they're just keeping margins up. And you look at the earnings per share beat. A lot of that's driven by the fact that they've been buying so many shares back. They bought 250 million back just in the quarter, getting closer to that 1 billion share mark that they want to get below next year. But look, you can't buy back that many shares if you're not generating a lot of cash. And that's what the company's doing, and that's what the analysts like right now.
I have to say, it's really impressive to see GM shares up close to 8% right now. Their total gain for the year is close to 48% year to date when it comes to total return, really outperforming the rest of the industry mightily, also outperforming the rest of the market as well. But of course, they're reporting earnings with just 2 weeks to go until the presidential election. What did Mary Barra have to say about what trade policy adjustments might look like?
GM's never going to stick their neck out in terms of, what one candidate or the other. But they're watching trade policy closely, and if they needed to adjust because of tariffs, China, they don't make a lot of vehicles there, but if there was an adjustment from Mexico, that would hit them because they make a lot of vehicles there and bring them here. But that doesn't seem to be in the offing. I think they'll, as long as it's not tariffs to Mexico, I think they'd be fine. You got some Buicks coming in from China, but it's not a lot. Maybe they have to bring that vehicle to China. Maybe they have to bring it to the U.S. But it's not something that hits them unless we're looking at a total redo of USMCA.
We might never notice if no more Buicks came in at all, David. The EVs, to me, is the most puzzling issue. We've been showing the Escalade IQ, really handsome vehicle, but GM doesn't seem to be taking the kind of hit that Ford is. We hear about these multiple billion-dollar losses at Ford, and GM seems to be navigating this well. Is that the right interpretation?
Well, yes and no. I mean, GM just isn't putting out the number, the amount of money that they're losing the way Ford did. But what they did say in their investor day earlier in the month is that they're looking for next year to erase the $2 to $4 billion bogey that they have for EV profitability, which sort of implies that that's how much they're losing this year, $2 to $4 billion. But as they scale up, because remember, GM's they've got their own battery cell plants, and they've had this platform in the works for a long time. As they get scale there, they think they're going to be able to break even fourth quarter, first quarter on an operating profit basis, not total, but that's going to erase the drag on them from that.
We got to leave it there. That is Bloomberg's David Welch. We thank you so much for bringing us more from the GM story here. Of course, big mover today. We're going to give you another look at some of the earnings movers today. We're looking at GE because, of course, the aerospace business has been tough. You have GE now down almost 7% in the early trade. Kimberly-Clark down more than 4% now. And remember, organic sales really are not expected to rise very much. Organic sales for the Kleenex brand, due to lower inventories, also kind of muted here. 3M promising, but still down 2.7%. We're going to now talk to ECB's Christine Lagarde in the next hour. Stick with us ahead. This is Bloomberg.
Make sure that we're exposed to categories that continue to be relevant to consumers, that we're positioned in categories where we have a competitive right to win.
By strategically adding and shedding assets, General Mills has turned over about 20% of its net sales base in the last 6 years. It's dramatically expanded its pet food platform, starting with the purchase of Blue Buffalo pet products in 2018. That expansion dovetailed with a boom in demand.
Pet in the U.S., pet feeding and treating, is a $50 billion category. It's almost 5 times the size of a category like cereal.
Is this the future of the company? I mean, we so much associate General Mills with breakfast and cereals, human breakfast and human cereals. Are we now going to be thinking about General Mills much more as a pet food company?
I think you'd be thinking about General Mills as a food company where we treat all the members of the family like family.
The humanization of pets is actually the biggest driver of pet food and pet treating growth. It has derivatives in not only feeding, which is the core thing that most households where most of the dollars go against the pet, but treating, and then you start to branch out to things like vitamins and minerals and supplements.
People really love their pets. They want to take care of their pets like they do their family, and it really is a global phenomenon. That's why we recently entered the China market with Blue Buffalo. That's why we bought Edgar & Cooper recently in Europe, because we see the same kinds of trends that have played out here in the U.S. playing out all over the world.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything. This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are 2 big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Good Tuesday morning from the Bloomberg Interactive.
Wow, that's quite the outfit you've got on.
Yeah, as we can see, we can chat in real time to ChatGPT. And not only that, we can interact with it with video as well.
And I swear, if you look at Barrett's GPT history, it's all equations like this.
Now that you can do linear equations, can you show us something more complex?
I think so. Okay, next let's try something coding related. So let me take out a computer for this. Okay, so I'm going to open the ChatGPT desktop app, like Mira was talking about before. Okay, and to give a bit of background on what's going on, so here we have a computer, and on the screen we have some code, and then the ChatGPT voice app is on the right. So ChatGPT will be able to hear me, but it can't see anything on the screen. So I'm going to highlight the code, Command-C it, and then that will send it to ChatGPT, and then I'm going to talk about the code to ChatGPT. Hey, ChatGPT.
Hey there, how's it going?
Yeah, it's going really well. I was wondering if you could help me with a coding problem today.
Of course, I'd love to help you out. What's the coding problem you're dealing with?
Okay, I'm going to share with you some code. 1 second.
Sure thing. Take your time.
Okay, so I just shared some code with you. Could you give me a really brief 1-sentence description of what's going on in the code?
Weather data for a specific location and time period, smooths the temperature data using a rolling average, annotates a significant weather event on the resulting plot, and then displays the plot with the average, minimum, and maximum temperatures over the year.
Awesome, thanks so much. And in the code, there's this function foo. Can you describe to me what the plot would look like if I had versus didn't have this function?
Sure. The function foo xy takes in a data frame x containing temperature data and a window size y for calculating the rolling mean. It smooths the average temperature, minimum temperature, and maximum temperature columns by applying a rolling mean over the specified window. With the foo function, the plot would show smoother temperature lines because the rolling mean reduces the noise or fluctuations in the data.
Awesome.
This makes
Thanks so much. So yeah, I definitely will want to apply this function. And so I'm going to generate the plot and then show it to you. Give me 1 second.
Absolutely. Take your time. I'm excited to see the plot when you're ready.
Yeah. So far, ChatGPT has only been able to see the code. And now I'm going to run it, and then I'll use the vision capabilities of the ChatGPT desktop app so it can actually see everything going on the screen as well. Okay, ChatGPT. I'm sharing with you the plot now. I'm wondering if you can give me a really brief one-sentence overview of what you see.
The plot displays smoothed average, minimum, and maximum temperatures throughout 2018, with a notable annotation marking a big rainfall event in late September.
Fantastic. I have another question for you. Which months do you see the hottest temperatures, and roughly what temperatures do those correspond to?
The hottest temperatures occur around July and August. The maximum temperature during these months is roughly between 25 degrees and 30 degrees, 77 degrees Fahrenheit to 86 degrees Fahrenheit.
What's going on with the y-axis? Is this in Celsius or Fahrenheit?
The y-axis is in Celsius. The temperatures are labeled accordingly, such as average temperature, minimum temperature, and maximum temperature.
Yeah. So as we can see, not only can ChatGPT help me solve very easy linear algebra equations that I need help with, it can also interact with, code bases and see the outputs of plots and everything like this going on a computer.
Tell you it's going to be on such time in the course of 25. I think we all, governors of the Governing Council, and I'm sure you will be hearing lots of them in the next few days because they will be on air very much. I think we are all confident that 25 is the year when we reach our target on a sustainable basis and with the medium-term caveat that I have mentioned. But we have to be attentive to everything. We have energy prices that are low at the moment relative to where they could be. We have services going slightly down, but not much. We are still at 3.9% in the last reading, and we have to pay attention to domestic inflation. That is the segment of inflation that is proving resistant. And domestic inflation is largely based on services. Services in itself largely labor intensive, and we have to, as I said several times, we have to be very sharp in our analysis of the nexus between wages, profit, and productivity. That three-pillar platform will be very indicative of where services prices, which will inform domestic inflation.
You could have a situation where not all inflation indicators fall at the same time, right, in the next couple of months. Would you still feel comfortable if only some of them reach 2%? With the trend going that way?
If you want to have an average of 2% medium term, and that, for instance, the inflation of goods at the moment, at least based on the information we have, is 0.4, by necessity, you will have other components of your inflation measurements which are higher than 2%, because we think in terms of average number based on the proportion of products, services in the inflation basket, if you want to call it that way. So not all elements will have to be at 2%. We will need to have headline inflation at 2%. That's the target that we have set for ourselves. But where you have a point, I think, is we need to be as granular as we can in the analysis of inflation of services, because that is the one that is tricky and resistant. And we have to pay attention to what is sort of structural, what results from latest developments, what those latest developments indicate. Are those elements sort of what we call late comers? For instance, if you think in terms of insurance generally is, the premiums are renewed on an annual basis. Those are the ones that we call latecomers because they will increase their prices at the end of the year. We need to do the same analysis with wages. The beauty of Europe is that it is diverse, right? Okay. In some countries, they renew the collective bargaining agreement on an annual basis. So there is a relative regularity in the increases. In other countries, they will renew the collective bargaining agreement every 2 or 3 years. And there is a catch-up element. So we have to really, we have to do that granular analysis, which will inform where it's coming from, how long it's been in the making, what is the catch-up element about it, and how lasting it is for the future. So we need to look at information from the past, which is relatively stable, to see how it informs our assessment of the future. We do all that.
But so if you look at the economic blueprint that we're seeing for the moment in Europe, so inflation is coming down, wages are rising, the economy seems to be holding up, but what's happening with consumers?
I would qualify I agree with you, maybe except on wages, because I think that wages is at a bit of a pivotal moment where, and it goes back to my granular assessment. If you look at compensation per employee, it is beginning to go down a bit. If you look at negotiated wages, depending on whether you include the one-off payment catching up or not, it's also moving in the direction of lower growth than what we have seen. So that leads us to think that this wage increase that could have led to second-round inflation is probably beginning to abate now. But coming back to your consumer point, that's a really interesting European phenomenon. I think our narrative, the narrative that we gave in September, which is the fact that recovery will be driven by consumption, because the real income that households have or that corporates have to invest has improved over the course of time, that still holds. The timing of that is being extended. And the European consumers, certainly in general, do not have the same propensity to consume than the US consumers. You know, it's often said that, oh, as long as the US consumers consume, the economy will do fine. The European consumers are not on the same page of active consumption, I would say. And if I look at Q2, consumption has actually gone down a bit. Although real income, disposable income, had increased. And savings in Q2 again had increased. So it's as if, on average, the European consumer was sitting there looking at his real income increasing, looking at the world out there, looking at the war at the doorstep of Europe, looking at developments in the Middle East, looking at the political uncertainty around and thinking, well, I might be better off saving a bit more. And who knows, I might cut a good deal with my bank because the banks are still offering not generous, but possibly attractive rates for time deposits, rather than consume.
Do interest rate cuts help with that? Should they actually, or is it transmission mechanism taking longer than expected?
I don't think so. I think gradually reduced interest rates are being transmitted, and our monetary policy is traveling to financing, to the activity, and ultimately to inflation. So it should encourage spending, whether by way of consumption or investment. But on investment, we're not seeing much at the moment either.
Are you expecting it to pick up, or are there particularly weak countries that give you worries?
Well, there are countries that currently are not performing spectacularly.
When are you expecting them to pick up again?
Well, I think a revision of the business model and a collective endeavor to support the economy would be helpful, including, public spending.
But there's no real sign of that coming in some of these countries.
Well, nécessité fait loi. I don't know how you translate that.
Necessity usually leads to something, which is the overarching point. Madame Lagarde, when you look at monetary policy, so the markets really expect quite a lot of incremental interest rate cuts until April. Are they right?
It's their analysis. As I said, disinflation well on track? Have we broken the neck of inflation? Not yet. Should we jump to conclusion? Or should we not be a bit cautious? And as data dependent as we have committed to be, I think is our determination. Now, markets have their own way of looking at things, and they're playing with other people's money, and the more they make, the better, I guess. So my objective is price stability.
So markets could derail a bit of that if they misprice things. Do you just ignore markets, or do you try and guide them?
No, we don't ignore anyone. We look at what colleagues do around the world, what impact it has on us. By necessity, we have to factor in to our models what markets anticipate in terms of rate curve, but it's not to say that we are market dependent, far from it. But it's a component that we take into account. Yeah.
What would it take you to do 50 basis point cuts?
I don't want to speculate. I think for me, the direction of travel is clear, and what we have done, starting in June, is I think the sensible approach, and one that should be continued with that caution element about it, not jumping to the conclusion that, because we've done 25, we'll do 25 in each and every time. No. Or because we think that it's going to be down or up or this, we'll do 50. I think that's not called for, given how we are trying to really be solid in our analysis and be both data dependent, but also applying judgment and trying to look forward. And we need to scrutinize and be as granular as we can, because we are getting closer to the point where hopefully the economic situation will be in the right equilibrium. But to jump to conclusions and you will have people the whole week saying, it should be 50, it should be 25. No. Direction of travel, clear. Pace to be determined on the basis of backward and forward-looking element, using the 3 criteria and applying judgment. I think that's how I see it. But it's a collective endeavor in Europe. I'm lucky to have plenty of very smart governors around the table, and my executive board members. Everybody has a view.
Everybody does have a view. Yeah. When is the right time to start thinking about being less accommodative? I don't know how often you get asked about the neutral rate, or whether it just gets...
Very often and invariably I say, I don't know. Because it's not an elusive concept, but it's one that is, first of all, pretty complicated to articulate, and that is based on multiple factors, including productivity, aging, the impact of climate change, and all the rest of it. So if you were to ask me today, where is it? The honest answer is I don't know. I think fair to say, and credit to the research of the ECB, which is not the line adopted by either myself, the executive board, or the governing council, but I think their conclusion is that it's going to be lower than where it is today, and it's probably going to be higher than where it was anticipated to have been prior to COVID. So anywhere in between.
That's a big range.
I know it's a big range, but it's not like a mirage, but it's something that you can see, perceive, and identify the closer you are to that element, because it's an equilibrium where you have the perfect economic conditions, employment at potential, growth at potential. But we are not there for sure, and we are still restrictive, and will continue to be for as long as it's needed to get to that point.
I know that your mandate is only inflation, but we had the Draghi report, of course, on competitiveness. It was pretty alarming.
Draghi is former president,
so he comes into your fold. I mean, he was pretty alarming, actually, in what Europe needs.
No, I think that he was alarming in his diagnosis of where Europe is at, and I think I said it was alarming and fair or just. I forgot what I used. Because I think that he has conducted in his position as retired president of the ECB, retired governor of the Banca d'Italia, retired prime minister of Italy, he had this sort of paramount vision, holistic vision, if you will, of how Europe functions, what's missing, where are the gaps. And he had, a great team of economists and other experts who helped him and fielded his considerations and thinking, which is why I think his diagnosis is severe but just. His suggestions for the future in terms of what needs to change, what needs to be done, what reforms must take place, this is not alarming, or unless you say alarming because he's setting the alarm bell saying, now is the time to get on with it, please. And he's better equipped than anybody else to do that because he's been there, he's done it, he's seen the procrastination in play in those European leaders' council meetings. And I think I really like his report. I don't agree with everything that he says. And I think that our job now and the job of the Commission and the job of the European leaders is to filter out what can be done expeditiously without bumping into resistance and obstacles and territorial wars and turf discussions, to move the needle and to make sure that both on productivity, where there's a huge big lag, on a better energy sovereignty, on the fluidity of labor factor and capital, there is real progress. For my money, in my position, I would want those three components to really be addressed because it would make a difference for the fight that we have against inflation.
I mean, there are a couple of, I guess, concrete points, right? There's a huge cross-border possible banking merger that could or couldn't happen. There's, he mentioned, the joint issuance of EU bonds. What would make
what he said, I think, on the latter point, because it's a controversial one.
Yes.
Let's face it, the issuance of European bonds, we did it once with COVID, and you have a whole bunch of European leaders who say, oh, it was a one-shot deal, never again. So it's a highly controversial element of his report, which is why it's being picked up by media and others. He himself said at the Bruegel Institute, which is pretty thorough and deep into these matters, he said, you can read my report, take my report, move on with it, and take ownership without that chapter. Forget about the debt issuance. If it's going to be a battle between the Nordic and the Southeast, and forget about that. But do the rest. And I think he's right.
Would you be in favor of bank consolidation to almost signal that actually Europe means business?
There's two particular. I think productivity is the key battle. But it's not directly related to what we do. What is directly related to what we do, because of monetary policy transmission, notably, and because of the financial stability without which price stability will be an illusion, is number one, capital market union and banking union. Banking union, you can think of three pillars. Two have been built, and the third one is missing. So that's what, the EDIS, which is the European Deposit Insurance Scheme, does not exist yet. So every country is on its own, and that needs to be addressed. My colleague Joachim Nagel actually this morning committed a nice op-ed on that, and I'm delighted that he did. And capital market union, we have in some areas, post-market infrastructure, we have 27 different backbone. That doesn't work. Or it does, no, I shouldn't say it. It works, but it is suboptimal by a long way. And one of the strengths of the US market has to do with the capital market that is vibrant, deep, liquid, and I think much more easily accessible than it is in Europe.
Is the window for Europe to get its act together narrowing? I mean, we also sit, if you're European, between the US and China. The IMF also.
You could argue that it's a strategic place to be in.
As long as?
As long as it is solid and strong enough to stand with its own sovereignty and its ability to keep the savings at home. That's one example. There is so much European savings that travel the world because they don't have an instrument or a market in which to invest.
But what are you optimistic about going forward? I know there's, we talk a lot about tariffs, we talk a lot about trade also being rebuilt now because of geopolitics instead of economic advantage. That must make it harder for Europe.
Well, first of all, there is a lot of trade that takes place within Europe. It's not necessarily well accounted for, but there is a lot of goods and services movement within Europe that can be improved significantly. And you need to look at the Letta report in addition to the Draghi report. And Enrico Letta, former prime minister as well, makes the case for better European integration. Remove some of the obstacles, do away with some of these multiple licenses to operate, the prior authorization here, prior authorization there, and have a real integrated deep market, one of the largest in the world. But we keep procrastinating about little boundaries everywhere. So that integration will increase, in my view, the trade that is within Europe. And I think it will also encourage investment in Europe, because investors look at the general terms, the tax regime, but they look first and foremost, what is the market? Where will I sell? Is there a deep and wide market? What scale can I get as a result of my investment? So I think that a lot is in our hands. I don't like restrictions to trade. I'm a former trade secretary for my country in France, and I just know how much trade can bring in terms of competition, in terms of added innovation, in terms of elasticity. I think trade is helpful, but the trade conditions have to be fair. They cannot be constantly subsidized in a very opaque and unfair way.
I was going to ask you, so we recently had an interview with a US presidential candidate who said tariffs was his favorite word. I imagine because of also your background, former IMF, former trade minister, this is not your favorite word. What is your favorite word?
I think fair trade is a key boost for growth, for employment, for innovation, for productivity. And I would say that it's something that we should not throw away, because in any period of time where this country, the United States, has thrived, were periods of trade, not periods of, I'm going to retire behind my boundaries and play at home. No.
I mean, there was a big UK media outlet that called the US economy the greatest economy on earth right now. I mean, would you agree with that? Where does it leave the rest of the world?
I think it depends where you are on the social ladder. I think you have to go further than look at the sort of aggregate numbers or the average numbers. It depends on where you are on that ladder. If you are at the bottom of the ladder, if you have small job, not much by way of income, I'm not sure that you think of, being in the first and best economy in the world. So everything needs to be considered. But it's a case that the US, for instance, has very high productivity, has a very vibrant tech sector, and has had it for a long time, so it has capitalized on it since the beginning of the 21st century, and that there is a lot of catch-up taking place at the moment. But I think you cannot look at that in isolation. You have to look also at the people. And I think if you look at the Gini coefficient, which is probably not the best way to measure inequality, the US is not doing so well from that perspective. So it's also a question of spreading and distribution so that all people can benefit. Sorry, I'm being political now, forget it.
But do you worry about central banks being political or being dragged into the political sphere?
No, because I think there is a huge resistance to that in the decisions that we make, despite what is being suspected here or there in any place in the world. And I think for those central banks which have the privilege of independence, either by virtue of the treaties or the tradition, it's critically important to hang on to it and to defend it, because the credibility of an institution like a central bank really is a factor of how independent it is vis-a-vis the politics. And it's precious. It's very precious.
But do you think that you'll come under attack more? Not you personally, but just central banks. Donald Trump said, Jay Powell had the easiest job because it's a flip of a coin every month.
He should come and visit us. And I have I have thousands of hardworking people, economists, jurists, computer scientists, and I can assure you that they work super hard every day, not just once a month. And they are extremely conscientious and determined to really do the best job they can to deliver the right monetary policy and secure what is our common good, which is our currency. So we defend the euro and we fight for the euro, just as the Fed defends the dollar, fights for the dollar, I'm sure. I don't want to speak for Jay Powell, but I'm sure that's how he sees his job.
We're just kicking off IMF World Bank Week. What are you most looking forward to?
Oh, seeing my friends. That's the first one. And I'm not saying that just jokingly. I think that there is huge value in meeting people who are equally concerned, who have the common good at heart, and who will, inform each other of where they see things, what obstacles there are, how we can better cooperate. And it's some people say, oh, it's a big talking shop. Yeah, but it's better to chat than to war, as Churchill would have said. And cooperation, with the caveats, with the difficulties, with the temptation of protectionism and all the rest of it, but cooperation is at the very center of keeping some sanity in this world.
I mean, the world is so complex. If there was only one thing that you would like to figure out this week, what would it be?
Peace.
One question.
Peace. If you ask me one word, that's the one that I would use. Because when I was IMF managing director, I have seen the destruction and the disaster that war can bring about. And I have seen countries that had gone through programs that were just graduating from programs, falling back into poverty, into economic disaster because of war. So yeah, the world as it is, if there was one thing that I could achieve because I have a magic stick, it would be peace.
Do economics come into play though? It feels different this time.
Well, the wars that we have out there, and it's not just Ukraine and the Middle East, there are many other theaters of operation, like Sudan, for instance, not much talked about, that bring uncertainty and that undermine the confidence that people have. We were talking about the European consumer being uncertain. I think, the uncertainty is fueled by the lack of confidence. What will the future be like with those wars on the horizon and the political uncertainty about addressing them and resolving them?
Christine Lagarde, thank you so much for your time today, and we wish you a successful IMF week. Thank you.
And to you too.
All right, that was European Central Bank President Christine Lagarde speaking exclusively with Bloomberg Television's Francine Lacroix in Bloomberg's Washington, D.C. bureau. Molly Smith and Paul Sweeney, along with John Tucker, we're live here in the Bloomberg Interactive Brokers studio, streaming live on YouTube as well. Let's go from the European Central Bank to the U.S. Federal Reserve Bank. What's our Fed going to be doing here in the month of November? Ira Jersey, he joins us. He's Chief U.S. Interest Rate Strategist for Bloomberg Intelligence from Princeton, New Jersey offices. So, Ira, I'm looking at the bond market here today, and it's kind of got my attention here. I got a 10-year at 4.19%. When did that happen? What's going on in the bond market these days? A lot of yields moving higher here across the board.
Yeah, I think that, there's a couple of impetuses for this. So firstly is the somewhat better than expected data that's really moved up, not so much the near-term outlook for the Fed, but really the longer-term outlook for the Fed. So when you price out about 75 basis points worth of cuts for the entire cycle, that's going to permeate itself throughout the entire yield curve, and in particular that 5 to 30-year sector where you're going to see longer-term yields end up coming up much more quickly. And then the second, quite frankly, and this is something that we're going to be highlighting in a note very soon, is that there seems to be a pretty dramatic correlation between the odds of Donald Trump winning the presidency and 10-year Treasury yields. And I think two reasons for that. One is the market sees Trump's policies as being a little bit more pro-growth. And then secondly, and I think this is maybe the bigger concern in longer term, is that Donald Trump is seen to get that growth via potentially higher deficits, so more supply. So I think both of those things, both the economics and also the election coming up are the two main factors.
That's really interesting. I mean, but I think there's also been, we did a Bloomberg survey of economists, and it was so interesting because the policies between Trump and Harris really couldn't be more different. But economists see borrowing costs and the 10-year yields being roughly the same under either candidate over the course of 4 years. I mean, how do you square that? Does that also mean that Kamala's policies are also fairly pro-growth, or that just generally adding to deficits as well?
So two different things. So firstly, I disagree with that assessment that if that's a consensus of economists. So first is, generally speaking, Harris's, I think, policies would be a little bit more inflationary, but not necessarily very pro-growth, right? So there's a difference between more government spending in certain sectors that aren't necessarily productive versus, things like what Donald Trump wants to do, which maybe, Trump's policies might actually increase income inequality in some ways, but would overall potentially enhance growth, whereas that might not necessarily be the case in a Harris administration. I mean, not dissimilar to what's happened during some other cycles. But, all of this is speculative. We don't actually know what's going to get passed. We don't know if there's going to be split government or a single party in power. So, I do agree with the idea that, look, both parties, neither of these candidates is fiscally conservative. There's, both will likely increase the deficit pretty substantially. It's a matter of, what does it do for things like inflation and as well as economic activity in general. That's probably spurring some of this. And I'm not saying the market's right. The market. This is just my observation of what the market is actually doing, as opposed to whether I think that the market is justified in its assumptions that Trump's going to be more pro-growth and see higher interest rates than a Harris administration.
Ira Jersey, thank you so much for joining us. That is the Ira Jersey. He's Chief U.S. Interest Rate Strategist for Bloomberg Intelligence, safely ensconced in our Bloomberg offices down there in Princeton, New Jersey. Looking at the yield curve, you got the 2-year, 4.02%. And then you got some actual steepening there. The 10 years at 4.19%. So higher yields out on the curve, which is where you like to see it. We were inverted for a long time. We'll have more coming up. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash, and is being brought to you by Interactive Brokers Portfolio Analysts. Consolidate, analyze all your financial accounts on one powerful dashboard for free. Sign up for portfolioanalyst.ibkr.com/free-PA. Stocks seeing the first back-to-back decline in 6 weeks, with traders considering the prospects of a slower pace of Fed rate cuts. 10-year yields, they briefly top 4.2% for the first time since July. And for now, Kurt Ryman at UBS Global Wealth Management isn't too worried about the recent rise in rates.
I think that move higher in yields is more about a growth pickup than it is about anything related to necessarily concerns about inflation. So if we get inflation leading to higher rates, then I'm concerned.
Right now, the S&P 500, 21 points lower. The Dow Jones Industrial Average down 187 points. The NASDAQ 100 down 25 points. The 10-year yield unchanged, 4.19%. The 2-year unchanged, 4.03%. 3M increasing the low end of its 2024 profit forecast, reporting third quarter earnings that topped analyst estimates. 3M shares down 2.6%. General Motors signaling solid demand for its highest margin vehicles, even as the broader market starts to soften. We have GM shares up 7.3%. And Peloton Interactive partnering with Costco. A Peloton stationary bike will soon sell at Costco stores and on the website. I guess the idea is you get like bulk potato chips and then just jump on the bike.
You get the hot dog and a soda for $1.50, then you hop on the bike, I think.
There you go.
Costco.
Probably the most efficient workout program, honestly. Like, I mean, if you're going to buy the big bag of potato chips, you got to get on the bike after.
Yeah, I know. When I think fitness, I think Costco. We check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Molly and Paul.
All right, John Tucker, thank you so much. We appreciate that. Molly Smith sitting in for Alex Steele. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker studio. We're streaming live on YouTube as well. Boy, it just seems like for the last 5, 6, 7 years, there's been this growing tech Cold War between China and the West. And now we got a story out about the chip maker ASML Holdings, the CEO. He expects pressure to grow from the U.S. to further restrict sales of semiconductor technology to China. That's the biggest market for the Dutch producer of chip-making machines. Mandeep Singh joins us. He's our tech dude. He's ahead of all the technology stuff at Bloomberg Intelligence. Mandeep, talk to us about the chip market, China as a customer. How do you think this is going to play out? Because again, it feels like there is this tech Cold War that's right there.
Yeah, I mean, when you look at a company like ASML, which almost did, 45% of their revenue from selling to Chinese customers over the past 12 months, and they guided to that percentage going to about 20% next year. So clearly, the deceleration is huge in terms of the China exposure. And partly that has to do with the, the Cold War or the geopolitical element that you just alluded to. And look, it's not surprising given ASML, the machines they make underpin the latest factories that are producing these chips that everyone wants to train their AI on. So when you look at the semiconductor chain, I mean, ASML sits at pretty much at the bottom end of what it takes to set up a semiconductor factory. They are deemed as one of the biggest beneficiaries of the CHIPS Act. When you think about, the U.S. government wanting to set up semiconductor fabs in the U.S., they are one of the prime beneficiaries. But then the offset is the China business that is going down, and that's why you're seeing, valuation compress recently.
Can you just help catch us all up here, Mandeep? Because this has been a crazy week with ASML, going back to the earnings announcement last week when they cut their outlook for next year. The orders were very disappointing. This triggered this whole rout in the semiconductor industry. Can you just catch us all up here on what the past week has been like?
Yeah, in fact, it's been a roller coaster because you had the ASML disappointment, and then TSMC comes out the next day and they say AI revenue will be almost mid-teens, which was negligible over the past, 3 quarters. So clearly there's been a big kind of change in sentiment when it comes to TSMC being very bullish on AI versus ASML downplaying, the next 12 months. And that's partly to do with where TSMC sits, which is they are getting all these orders from NVIDIA, as well as other hyperscalers who want to get their chips manufactured at TSMC, whereas ASML has got two companies that are pulling back on their orders, Intel and Samsung. And TSMC is the only one that's buying from ASML right now. So TSMC has a lot of bargaining power because they are the only ones who can raise their capex. Intel is really struggling. Samsung, we have heard, is also struggling now. So both those companies, the next two big buyers of ASML, are looking to pare back their spend. And that's why I think TSMC is in a great spot, both from the customer side as well as having the supplier bargaining power.
All right. ASML is a Dutch company. If the U.S. tells me to do something, why don't I just tell them to go take a hike?
Well, I mean, it goes back to how these kind of countries work as a bloc. Look, I think when the U.S. government kind of asks a country to enforce their restrictions, then most of the times they end up doing that because of, the trading aspect of how these companies just operate as a block. And in this case, I think the restrictions are very targeted towards advanced machines that are used for latest leading node manufacturing. So I think, again, it comes down to how the politics of it is really focused on. And it's hard for the companies to control that, right? So if the governments agree on something, they have to comply with the restrictions.
So we have the ASML CEO. He's been speaking at the Bloomberg Tech Summit recently, and he said last week that he sees the chip market's long-awaited recovery extending well into next year. You think that's a fair timeline, given all of what's going on in the industry right now?
I mean, there are two pockets here. One is the AI pocket, which is really firing on all cylinders. I mean, companies have insatiable demand, and we have seen that with TSMC and NVIDIA really kind of talking about it endlessly. On the other side, the traditional markets like smartphones, PCs, autos, they're still slow. I mean, there has been a rebound, but it's been very kind of flattish for a few quarters. And even the prognosis is not like you're going to see massive acceleration in top line growth. So that's where I think companies that are exposed to AI are growing much faster than the companies that are exposed to these traditional end markets.
And is that just because the market for smartphones is pretty saturated at this point? Like, don't we all pretty much... I mean, it seems pretty ubiquitous now. I mean, how much more are there really like these big markets that are waiting to be tapped into?
I mean, that's where AI will play a role in terms of driving upgrade for your smartphone. It's just right now, AI is being consumed and deployed almost solely on cloud. That's where the cloud vendors are seeing it in their results. But for every edge device, whether it's PC, smartphone, nobody has talked about using AI on the device. I mean, you can do it through your app that is running on the cloud, but you don't need to upgrade your smartphone for that, and that's the big driver.
I just upgraded to the iPhone 16 Pro. Somebody told me that. Your partner, what's his name? Anurag. He told me to upgrade.
Look,
you sell me a bill of goods here? Trying to pad the Apple numbers?
It is, and look, it still has a great camera. So I think that upgrade.
I was in Ireland. I was in Ireland for like 8 days. I took 3 pictures. 2 of them were like of sheep and 1 of a pig.
Come on, you are underutilizing your asset, Paul. So.
What's the fascination with the sheep, Paul?
There's more sheep than people there. Okay. They're everywhere. I mean, it's unbelievable. No wonder my people left when the first potato went bad. All right, Mandeep Singh, thank you so much. We appreciate it. Mandeep Singh, Senior Tech Industry Analyst for Bloomberg Intelligence, trying to figure out what's going on in the chip business. Again, ASML, they're cautious. Taiwan Semiconductor says, no. Business is still good. So,
honestly, I'm trying to more figure out what's going on with your picture taking.
Yeah,
personally, and like what you have to show for from this trip to Ireland.
It's just, you got to live the moment, be in the moment. Stop recording it and taking photos of it. Just live in it.
I think this is really just like right here. This is like the difference between what a man and a woman would take pictures of on a vacation.
I think it's more generational, actually.
Yeah, I think you're right.
We could do that
generational too. I mean, you see a picture from 30, 40 years ago of Tiger Woods hitting a good shot or Jack Nicklaus. Nobody has a phone out. But now, go figure. This is Bloomberg.
is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, Molly Smith sitting in for Alex Steele. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube. And help make shows like ours even better by taking our Bloomberg Audience Survey. Visit youtube.com/Bloomberg Podcast and click the link in our profile or community section to take the survey, which is hosted by our partners, Material. Fill out now at youtube.com/Bloomberg Podcast. There you go. Let's talk about European banks. We had the big U.S. banks report over the last week or so. Really strong numbers coming out of the big global U.S. banks and investment banks. We're going to get some of the European folks coming up, and we also got some news coming out of HSBC, one of the big European and Asian banks. Got kind of a little restructuring there. So let's check in with our Euro banks official, Tomasz Netzel. He's a senior European banks analyst for Bloomberg Intelligence. Tomasz, thanks so much for joining us here. Talk to us about HSBC first here. They got a pretty big restructuring going on at this bank. Tell us what's going on there at HSBC.
Yes, thank you very much for having me. Yes, definitely. Today, all over the news you can hear is the biggest restructuring in almost a decade. And I would say that I think it is the continuation of overhaul of restructuring of the business, which started at the beginning of 2020, more or less by the previous CEO. We have got new CEO starting his job at 1st of September, and I think one of his priority was how to make sure that we can sustain mid-teens ROT for beyond 2024, 2025. How do we deal with the business in the declining interest rate environment, and what do we do with the costs and the restructuring of his business he proposed and introduced from